Good morning. It is Friday, January 27th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi, who thankfully always are here to back me up and tell me what day it is, if I don't already know, which sometimes I don't. Let's take a look here at futures this morning because we do have some economic data out this morning. Personal consumption expenditures, which is always the Fed's preferred inflationary measure. In December, core PCE coming in exactly as expected, 0.3% month over month. We did not see a heck of a lot of reaction in the futures, which already were trending lower. You see there, S&P futures, Nasdaq futures also down about 0.5%. And if we take a look at treasuries as well, this is the price, which moves inversely to yield. Again, here, not a lot of change, a little bit off the lows here. So this means if prices are lower, that means that yields are a little bit higher here. You guys, just running through some of the other numbers that we got here related to inflation. Basically, what this does is sort of props up the government case, if you, or the Fed's case, if you will, to continue to do what it's been doing. The inflation is moderating to some degree here.
Yeah, and the increases in compensation as well. That was highlighted within this report, especially as it related to the increase in current dollar personal income here. So those increases in compensation, those reflected increases in private wages and salaries in services producing industries and goods producing industries. And why I bring that up is because this also plays into some of that disposable personal income that was reported in the report. That actually went up by about 0.3% for the recent month.
Yeah, I mean, I think, of course, the read here is that inflation is clearly slowing. That probably locks in a 25 basis point rate hike from the Fed when we hear from them shortly. Market likes to hear that. And I think, off of this report, we saw a little bit of reversal in the futures, as you would expect. I mean, maybe now we can start getting back to that talk of a Fed pivot and what essentially would mean a pause in rate hikes by the middle of this year.
And we're going to talk much more about the consumer backdrop and what we saw. We also got personal spending numbers for December that were down by 0.2%. That's a little bit of an acceleration from a drop of 0.1% in November. In other words, consumer spending was pulling back a little bit, which is interesting. It was happening during the holiday season. We also got a lot of the card companies, the credit card companies reporting, which we're going to talk about in a little, and about what that signals about what the consumer is doing.
Yes, indeed. All right, card spending. But first, let's start with Intel. Intel posted shocking guidance on its earnings release last night that stunned investors and has sent the stock plunging. The legendary tech company also missed Wall Street's expectations for the fourth quarter, with its forecast pointing to more trouble ahead. And I think if you roll back the tape to how we discussed Intel 3 months ago, we will have used the same language, just wow. And it wasn't just the weakness in the quarter, the company operating, just really missing on earnings. It was also this outlook and this sense coming off this earnings call that things are not going to get better for Intel this current quarter, the next quarter, or maybe any quarter this year. And it just, I think, signifies just the continued struggles and the transformation that Pat Gelsinger has to drive here to catch up to the likes of an AMD, NVIDIA, you name it. Yeah,
break out the mullet wigs, if you will, because that was certainly talked about on the earnings call. And of course, this is the mullet trade that we had talked about with Jefferies analyst Brent Thill once before, and this kind of business in the front, party in the back. But it's a big question for Intel because there are other factors that are impacting them a little bit more outsized than the rest of the market, which we'll break down. But what they said on the call is that they're expecting more positive expectation for the second half of the year. And some of that is revolving around a recovery in China as well. But in the near term, profit margins, those gross margins of 39%, well off of what investors had come to expect for almost a decade of roughly 60% in that same category.
It might be coming, but they were so uncertain that second half recovery is coming. They didn't even give a forecast, right? Yeah. And I think you really have to parse Gelsinger's language here. He said the possibility of second half improvements. There is not really any optimism baked into this. And the other interesting thing that caught my eye from the call, the head of investor relations saying that the first quarter is going to be the most significant inventory decline in our customers that we've seen in recent history. And that has to do especially with the PC business. And the company said PC sales this year are going to be at the low end of their forecast. But also, you and I were talking about this morning, Saz, the data center business, which had been a growth driver for the company, is also not doing great.
Yeah, data center, key margin driving segment for Intel, and they continue to lose market share to the likes of an AMD. And I think this is going to be another just turnaround or transformation year for Intel, and they've acknowledged that they may not gain leadership in the chip space until 2025. So what happens in between there? Now, there is one comment, and I'm not seeing it talked about, but they mentioned this on the earnings call last night. I think it was Pat talking about they're looking at other value-creating initiatives over at Intel. That definitely rose my spidey sense. Unclear what that actually entails, but is it more cost-cutting? This is a company that just 3 months ago outlined $10 billion in cost cuts through 2025. So it's unclear to me what else could be under that umbrella.
Yeah, in terms of initiatives, they mentioned some of the initiatives that are underway, trying to improve the gross margins, $3 billion in reductions that they had talked about for 2023, and $1 billion of that is in the cost of sales. So that could parse back to, or at least relate back to, that cost of sales or that headcount reduction that you're talking about as well.
And I'll just quickly add here too, before we go on into another angle, is I just don't think this is Pat's issue per se. I think this reflects really decades of just mismanagement at Intel. Now, yes,
we're going to talk about. Can we talk?
Yeah,
let's pivot for a minute, okay? As Intel does continue to stumble and warn of more trouble ahead, some of its rivals in the semiconductor space are picking up speed. Two big winners off of Intel's market share losses: Taiwan Semiconductor and AMD, both who have been taking business away from Intel quarter after quarter. Now, let's talk about why that has been happening, because every chip maker, right, is suffering from these macro headwinds that we've talked about, including AMD and TSM to some degree. Intel seems to be suffering the most, and that gets to what you're talking about, Saz, which is what is different? What are some of the missteps that Intel has made that have brought us to this point?
It's something as simple as, well, maybe two different things. First, AMD has been a beast over the past decade, especially under CEO Dr. Lisa Su. NVIDIA has been a beast under Jensen Huang. You know, and Intel, I go back to when Bob Swan was leading, before Pat, and leaders before that. I mean, it went as so far as they removed, I believe, key performance indicators. You essentially had executives not just driving accountability throughout the organization, and then over time that really helped them or led to them losing market share and putting out really best-in-class products here. So Pat was brought in, I believe, over 2 years ago to help turn this thing around, and a transformation of an iconic manufacturer like this does not happen overnight. So just to hear Intel say 2025 is when they become a leader again and compete with an AMD and its various other competitors, I think is very telling. It takes a while to turn a ship like this around.
Right, and it's going to have to come on more spending, which is going to compress margins even more. When they enter into this, $30 billion, multi-billion dollar partnership, not just with Brookfield, but other partners as well, to try and bring up their foundry services, to try to be able to produce and bring online more capacity. That's more money out the door for Intel. And then where does that continue to have to move forward? They've got to continue to source materials to bring into those different operations. And that is a 5-year lead time, at least, by the time you not just break ground, open up the capacity, and then additionally start to ship out to partners, and then investors start to recognize that. And so I think investors are trying to, as best they can, get ahead of these wave of spending that Intel is going to have to do in the near term. That makes some of the other players more viable as investment opportunities, perhaps. And that's why you see over the past 5 years an AMD soaring by about 500% in its stock price and its share value, while Intel over the past 5 years is down by about 34%.
Well, and it also illustrates why Intel has so much work to do to catch up with it. I mean, because all AMD needs to do is keep doing what it's been doing. Yeah. Intel needs to really get a big step up here. And I don't think that there's, from an execution perspective, it doesn't seem like the likes of an AMD or some of the other chip makers are wavering, even though obviously we are in where we are in this glut environment for the chip industry. Right.
What AMD unveiled at CES a couple of weeks ago is incredibly impressive, and it is likely to keep AMD as a market share gainer.
Yeah. Well, Intel continues to lose steam against its competitors. Is this as bad as it gets for the chip giant? That's the big question, or is there still more to come? Let's dive into it and what the street is saying with BofA research analyst Vivek Arya. Vivek, maybe we start with that very question. Is this as bad as it gets for Intel?
Good morning. I think, another shock and awe report from Intel. Of course, there is a cyclical aspect of it that PCs were one of the biggest beneficiaries when we were all locked up, right, at our homes during COVID. So we are seeing the other side of it. So there is a cyclical part of it. Let's not forget that. But I do agree with you that some of the problems are a lot more Intel specific. They're a lot more exposed to PCs, so the declines do hurt them more. But there are competitive risks. not just to AMD. I would also mention that part of the PC market, for example, in the past, Apple would buy their processors from Intel, and now Apple is designing their own processors. So 10% of the PC market has gone away, and there is a sheer shift towards ARM in the PC side. So that's one problem that I don't think gets reversed. It gets worse. Then on the data center side, yes, there is a share shift to AMD, and they benefit from that. I think the other very important issue that is happening under the surface is that there is a move from CPUs, which Intel makes, towards accelerators. So, for example, look at all the hype around generative AI and ChatGPT. Every one of those servers could have 1 or 2 CPUs, but has 7 or 8 GPUs. So almost 4 times the number of GPUs, and each of those GPUs is priced at 5 times the price of a CPU. So that, I think, is the other structural issue that Intel is facing, that the value of computing is moving from things they are good at, which is CPU, towards GPUs, which they are not good at. So I think there is no quick fix here. Maybe the cycle gets reversed a little bit, but we feel that the issues are a lot more structural.
I mean, that makes it sound like Intel effectively, Vivek, is going to become obsolete. Is that the case? Is there anything they can do? I mean, it seems late for them to sort of pivot into GPUs in a more decided way.
Right. They do have the power of incumbency. So what we spoke about really affects more of the cloud service providers. They are the fastest growing part of the market. So that part of the market, Intel faces the most competitive pressure. But if you look at parts of the enterprise, Intel has a very strong brand name, very strong presence. There are many enterprise applications where you're really not trying to push the envelope as much. They're not growing that quickly, but still Intel has incumbency in those parts of the market. Some of their other businesses in programmable system solutions, some parts of automotive, they're doing fine. So I think over the next 2-3 years, we don't see Intel completely, getting off the map, but it is going to be a tough slog. And the challenge is trying to outcompete their fabless competitors who are just focused on design, so they can be very agile and they can take advantage of Taiwan Semi's manufacturing and the cost structure. And on the other side, Intel has to also compete against Taiwan Semi from a manufacturing perspective. So I think they are facing 2 different challenges at the same time. So it's going to be tough going for the next few years.
Vivek, maybe you can make sense of this. So we were just talking about Intel flagging on their call last night, looking at other value-creating initiatives. Would that include a dividend cut? Do you think they have to raise cash to just drive the turnaround that they're trying to do over the next few years?
Yeah, so first on the topic of the dividend, we are of the opinion that dividend is at risk. Last year, they were able to divest some of their McAfee business, so they got some cash because of it, and there was a small amount of grants. Otherwise, on a gross basis, they had a $9 billion cash burn. I think this year also on a gross basis, there is a $9 billion cash burn, but they are going to get some government subsidies. Brookfield is investing in one of the fabs. So maybe on a net basis, the cash burn is not as much, but it's just mind boggling how one can support a $6 billion dividend when there is so much of cash burn in the core business. So I think that is at risk. Now, things that they can do, right? First, think of the Mobileye spin that they did last year. They could continue to divest more of their stake in Mobileye. There could be other parts of the business. Anything that is not x86 related, which is a CPU or a PC or a server, anything that is not x86 within Intel is always at the risk of divestment because it's not something they produce in their own fab. So there could be other small parts of Intel that they could choose to divest and kind of keep the boat afloat for some time.
So Vivek, given all these things considered, does that make Intel stock right now untouchable?
We have an underperform. We have a $25 price objective. As I mentioned, that the risks are a lot more than cyclical. I think they are structural risks, right, that the company is facing. Now, what they can try and make go right is they can, try and catch up in manufacturing. It's going to take another 1 or 2 years. Right for them, but that's a path that they are on. It is possible that the PC market maybe recovers a lot more on the other side because the PC usage has definitely gone up versus the pre-COVID levels. So there are things that could change at the margins. More near term, a China recovery could help them. So I think there is possibly a small jump off a low base, but for Intel to fly again, I think that's a very tough scenario to envision at this point.
Vivek, before we let you go, who's your top pick in semiconductors? Obviously, if Intel would be sort of at the bottom of the barrel, maybe for lack of a better term, who would be at the top?
Yeah, I would say on the computing side, we have always maintained that good exposure to semis. You have to look at the 3 C's of semis, as we call them: cloud, cars, capex. Cloud is NVIDIA. It's very hard to beat them in AI, and everything we hear about OpenAI, I think they're the biggest beneficiary. I think on the car side, names such as ON Semiconductor, NXP, very interesting. And capex is all the semi-cap equipment companies, Applied Materials, KLA. I think they are going to be the beneficiaries of this race between Intel and TSMC and Samsung, stimulated by all the money that's going to come from US and EU CHIPS Acts. So cloud, cars, capex, I think a good exposure to semis involves all 3 of those themes.
Vivek Arya, the senior semiconductor analyst over at Bank of America. Thanks so much for taking the time here to break down all things Intel with us this morning.
Pleasure. Thank you.
And be sure to tune in later on this morning. Brian Sozzi going to sit down with Intel CEO Pat Gelsinger. They're going to talk earnings, outlook, and everything in between. That's at 11 a.m. And coming up, fantastic plastic. We're going to swipe through some earnings from American Express and Visa on the other side of the break. Or tap through, I guess. American Express reported earnings for the fourth quarter this morning. They missed estimates on the top and bottom lines. The financial services company did issue some stronger than expected guidance, though, for fiscal year 2023. They expect revenue to grow, and we're going to be taking a look at some of the figures here in a moment. Commercial services, that was up 15% from a year ago during the quarter. International card services, that also jumped year over year, but it was significantly impacted by the strength of the U.S. dollar, they did note. And it was actually global merchant and network services that grew 20% in this quarter, too. You actually spoke with the leadership there, too.
Yeah, I caught up again with Amex CEO Stephen Squeri ahead of our show. noting he's not seeing recessionary signals. I go deeper in this in a story on the Yahoo Finance homepage now, but nonetheless, no recessionary signals for him. Kind of fits well with what we heard, I guess, from Visa and MasterCard, which we'll talk about in a second here. Saying travel bookings are up now over 50% versus pre-pandemic. Overall, good quarter, but I think the stock is ignoring this earnings miss and really locked in on this guidance outlook from this company. The earnings were meaningfully above consensus estimates. To call out 15% to 17% revenue growth when we're seeing a lot of layoffs in the tech industry, a lot of those Amex cards might be getting put away because those employees are no longer working with the company. An interesting outlook for the company, a very bullish outlook, and the street appears to be paying more attention to this.
I mean, what's interesting to me about all three card makers, which have now reported, all of them saw volumes that missed estimates. All of them saw volumes increase, that is, spending on their cards increase, but all three of them missed estimates. So spending on Visa cards rose by 1.7% to about $3 trillion. It's the biggest. MasterCard's spending rose 11% volume to $1.73 trillion, and Amex was up 12% to $413 billion. And again, all of these numbers were below what analysts were estimating, which is especially interesting given, obviously, prices are rising. We did just get those personal spending numbers from the month of December that showed a decrease, so perhaps that's also sort of reflected in some of these numbers. That said, you know, when you look at how these companies did, even with those spending numbers missing estimates, things like the outlook even came in rosy here.
Both of them mentioned in January, and Citi highlighting some of these trends here. MasterCard noting that switched volume month to date so far in January up 21% year over year. That's
what is switched volume?
Just the volume going through their network, which doesn't appear to be recessionary to me. And then Visa, U.S. payments volume January month to date up 14% year over year. So pretty good, all things being considered.
You know, here's the thing that I'm really looking at right now is where they're investing. And for each of the card companies here, Visa, MasterCard, and of course, American Express, more on the corporate side. When you think about the amount of travel that's reemerged, all of them pointed out travel in one capacity or another, whether it's corporate travel or leisure travel. And one of the big investments that we heard about from MasterCard particularly, and this is based off an acquisition that they made, I believe in late 2020, is really looking at this no card present type of transaction. And that's huge because it's basically saying, all right, I'm just going to tap to pay here anywhere, or I've already got my credit card data scored.
And so you can pay for me.
Exactly. And so if you're tapping for those payments, then they're looking across where that actually generates a different virtual card number. And that virtual card number business is one of those opportunities that MasterCard's going to invest even more in, especially as you do have even more of this reemergence eventually of global travel, but then additionally just more of the no card present type of transaction. That's everything from your DoorDash order all the way to you doing some cross-border travel perhaps as well.
Well, and I guess also shows that even in a sort of a fintech digital world, these guys, you still need these guys.
Random nugget. You know, my time with Stephen is always very brief. Even 10 minutes on earnings day. But I did manage to ask him. I never asked him before what it means to have Warren Buffett as your largest shareholder. A little question outside of earnings season. Of course, Berkshire Hathaway owns, I believe, close to 20.3% of Amex, longtime holding. He says it's akin to the good housekeeping seal of approval, which is really, he said, also energizes everyone in the company. Pretty cool.
That's a super sort of mild, benign way to. It's good to be on Team Warren. I think what he was trying to say. You were right. It's 20%, 20.29%.
That's why I get paid the big bucks, Julie. You know.
Sure. You say so. All right, coming up, layoffs outside of big tech persist. Hasbro is the latest, slashing 15% of its workforce, but that's not all. We'll talk about its outlook too next. We got a couple minutes until the opening bell. Let's check in on some trending tickers right now. Hasbro, definitely on our list. It's announced it will implement organizational changes. That is a euphemism, maybe, for cutting jobs. That's 15% of its workforce in order to reduce costs. The toy maker also issuing some weaker than expected guidance for the fourth quarter. Revenue could fall as much as 17%. And the company said fourth quarter earnings will be $1.29 to $1.31. That is way below the $1.49 that analysts had been estimating. So not good.
Not good. And I think back, I did my take on Hasbro. They did an investor day a couple months ago and put out really these outlandish longer-term guidance ranges, which I said at the time looked completely foolish, and they look even more foolish today in the context of seeing fourth quarter sales down 17% year over year. And I talked to a couple investors in Hasbro, and they're just very disappointed by the execution at the company. They're waiting for some of these cost cuts that Hasbro has promised to really start to flow through to the bottom line. That has not happened yet. This notion that toys, I think, are recession-proof could be tossed right in the trash. Brad, I went to Target the final few days ahead of Christmas, and a lot of Hasbro's board games were collecting dust on their shelves.
Look, I'm going to look at one of the bright spots here. D&D. A lot of D&D, Dungeons & Dragons fans out there can be very pleased that Hasbro is saying that's still going to be a bright spot. It's also a big year for Dungeons & Dragons. Got a new motion picture coming out. And we know how well many of these action figures and toys will do off the back of a motion picture. I believe that drops actually sometime soon, March 31st, I believe, is that release date. And so for the fans of Chris Pine and Reggae Jean Page, they can...
That's who's in it?
Yeah, great cast.
I'm fans of those two people.
There we go.
Big fan. I will say also, but remember there was a resurgence, I think, because of Stranger Things, because the kids in Stranger Things were big D&D heads. And so I feel that was one of the
Hellfire
things
Club.
that helped kick off...
I'm not a D&D person.
And I was never... which is weird because I'm a huge nerd, that I was never played Dungeons and Dragons.
Speaking of all this digital world, Wizards of the Coast, Hasbro continues to be dragged on social media, whether it's on YouTube, these real hardcore followers on how they may have damaged that brand by flooding the market with various cards. So that is something I think a lot of investors are watching and mining the internet for.
Flooding the market.
Information. They saw the digital brand. They wanted to make more money for it. They flooded the market with all these cards and all this extra stuff. The market wasn't supportive of them doing this, and the true hardcore gamers have backlashed against Hasbro, and it has become a risk to that key brand.
That to me is something like what Nike is doing in trying to combat some of the resellers out there. If you got a card that's worth so much that nobody else can find it, and so many people are creating bots just to try and get one item or another, and then trying to resell or flip it, that doesn't make it fun for just the core people who are either out there collecting sneakers or collecting the cards. And so Nike doing that in one matter, and
one trend I never got into. I'm not collecting cards.
No, me neither. My kids do a little bit.
I used to do basketball cards.
So as we come up on the opening bell, a bigger picture question is the toy business recession-proof, right? That had been sort of one of, no, I don't think it is either. But that had been kind of a conventional wisdom, right? At one time that it was. There you have the opening bell on this Friday morning. And it doesn't, I think that there is, listen, I don't know. I guess every generation says this, right, of their kids. It does seem like there is a bigger, more meaningful sea change in the way that kids play. Not that little kids are still not playing with Barbies and other types of dolls and stuffed animals, but they switch over earlier to more electronic games.
No, it's a very good point. And I think that view that toys may be somewhat recession-proof will be put to the test when Mattel either comes out with some guidance here over these Hasbro numbers or they report their earnings. Mattel has been out executing Hasbro really for the better part of a year. So if the economy is slowing down, is this more a Hasbro story, their execution being absolutely horrible in 2022? Or is it Mattel just taking market share from them?
Right. Well, then we'll know also how Barbie did, right? Mattel is Barbie.
I got my niece
Barbie
3 Barbies
movie.
for
Speaking of
Christmas.
upcoming toy-based movies, Brad, Barbie, obviously that one is hotly anticipated.
Team outing.
Yes.
Team outing. We're going to go see Barbie together.
Barbie.
Done deal.
D&D or both.
Well, both. Why not?
All right, let's do it.
You can have it all. All right. Well, anyway, it is about how well we can turn some of these toy franchises into entertainment franchises as well. But in the meantime, let's let's take a look at some red on the screen. Dow Jones Industrial Average as of right now, it's flat, just barely to the downside here. Nasdaq Composite, that is opened lower by about 0.25%. And then additionally, the S&P 500, you're seeing that down by about 0.2%. Interesting move here that we're seeing out of the gate this morning. I want to take a look at some of the sector activity to see what's really weighing on the early moments of trade here. And it seems like energy down by about 0.7%, 0.75% there. And largely, most of the 11 S&P 500 sectors are in negative territory, except for these 4. You've got consumer discretionary catching a little bit of a nibble here on the day. That's up by about 0.3%. And then financials up by about 0.1%. Also, and XLRE, and we'll see how that waffles throughout the morning. But also taking a look at the Nasdaq 100 components, well, at least that we're showing here on the screen. There's more than that in the composite. But anyway, taking a look at Apple as of right now, flat just barely to the upside. Microsoft right now higher by about 0.4%. Google up by about 0.8% there. And then additionally, you've got Amazon. That's up by about 1.3% this morning.
All right, what is recession-proof is using toothpaste to brush your teeth. Colgate-Palmolive reports an earnings beat for the fourth quarter, topping revenue expectations as net sales increased 5% year over year. The company also issued some guidance as it expects net sales for the fiscal year to grow between 2% and 5%.
You still use toothpaste? That's so passé.
Well, I mean, I'm not going to brush my teeth with water, Julie, okay? Maybe I trade down in toothpaste in these tough times, but nonetheless, a good quarter from Colgate-Palmolive, another consumer products company that has had some success pushing through higher price increases given the inflation it has seen in recent quarters.
You know what? I just Googled this. I have switched over to Hello toothpaste,
yes,
which happens to be owned, it looks like, by Colgate-Palmolive.
I use Goodbye. No, I'm just kidding.
Goodbye, Sas.
Goodbye.
Please, Brad,
Bye-bye.
carry on.
Bye-bye. Gross margins, though, we're down during this quarter, decreased by about 110 basis points to 36% from 37.1% last year. And then additionally, that net sales decrease certainly something to keep a close eye on here as we move forward. But net sales were down by about 4%. That's compared to a 6% net sales decrease in the year ago quarter. So perhaps some of the waning on that net sales decrease as well. But it was driven by lower volume, offset by a favorable price mix, the company said.
You know, I wish the Colgate reported, Brad, the brush replenishment rate. They don't publish that.
Well,
You're
it's
supposed
also
to replace how often?
Well, it depends. You got the electronic one.
Yeah,
right?
it beeps like
Okay.
every month, every 2 months or something.
That's good.
They really get you. Those are like $20, $30 a pop, those in packages.
I got to look at the box on mine. I just got a new one for Christmas. I've been getting teeth products for the past 2 Christmases. I need to ask my family.
Are they trying to tell you something, Brad?
They are, yeah.
I don't know. But what also struck me in Colgate-Palmolive is it becomes the latest company to say costs are still going up, which is interesting to me, given, costs are going up when you look at the overall rate of inflation as well. It's going up at a lower rate, but it's still going up. But you do still have a lot of companies calling this stuff out, that Colgate's going to see raw and packaging material costs to go up in 2023 by several $100 million, mostly in the first half of the year because of higher agricultural prices. So it's interesting that companies, in other words, we're not done with inflation, right? Mm-hmm. The companies are still, and we're still experiencing rising prices.
I just giggle at some of that marketing. Consumer products marketing always just fascinates me on that advanced shield mouthwash. Like, wow, okay, I guess I'll pay an extra $2 for that. It sounds like it'll protect my teeth, my arms, and my feet. But just really interesting stuff.
I went to the dentist yesterday. Clean bill of health.
Good for you.
Just thought
Happy for you.
Throw that in there.
I got some gum for you. There we go.
We're going to ride high off of Julie's report while I text my family and figure out why they keep sending me stuff. Also here, we're taking a look at Mobileye this morning. Mobileye Global, ticker symbol MBLY. Do they have an alibi? Well, shares are up by about 2.2%, so it seems so. Reporting some mixed earnings, though, for the fourth quarter as the supplier of advanced driver assistance hardware and software saw revenue grow 59% year over year here for Mobileye. And as I mentioned, shares still holding on to some gains, although it was a mixed bag on earnings.
So Mobileye is one of the businesses that was spun out of Intel. Now I wonder, looking at these results this morning, is Intel happy it no longer owns Mobileye or sad it no longer owns Mobileye? This is the second quarter that the company has reported as a public company here. It had a pretty successful IPO, so it's just interesting to see this. Well, it was a company it spun off, but it had. But when did
Intel
it buy
acquired
them?
it.
Right.
Acquired it as a play on autonomous technology.
Right.
Now, Mobileye is seen as the lead here, but I think Intel is happy to have sent Mobileye packing. Now, great executives at Mobileye they have done some really good things, but for Intel, it is about just focusing on what they're supposed to be doing, making great chips and taking it to AMD.
Well, it's also a question of how much they might have needed the cash.
Yes.
And in order to put Mobileye into the equity market, and with that spinoff, Intel was going to be able to cash in on that investment that they made years ago as well. And so needing that cash to infuse it back into some of their own investment projects to build out the next leg of some of the fabrication that they would like to do for chips, I think it just goes to show how much they had already realized that they needed some of that money and were going to need to reinvest it back into their business.
Yeah, and it looks like the shares here are kind of weren't they up 3% just a second ago? Now it looks like they're bouncing between gains and losses.
Yeah.
But again, it does show that when you look across the tech industry, when you look across semiconductors and other types of technologies, there are some that are seeing this sort of long-term tailwinds, right? Yeah. And definitely sort of autonomy, automotive, AI are some of those areas where we're seeing that.
Auto holding tough. All right, coming up, Yahoo Finance's Jared Blickery will break down the latest for oil prices. We'll be right back. Welcome back to Yahoo Finance. Let's get over to Jared Blickery at the Wi-Fi Interactive. Jared.
Yeah, looking at a little bit of down action, but not much to begin the day, but it's been a positive week overall. Let's check out what the Dow has done. Now, 1.66%, I think the bulls will take that. And check out the Nasdaq. Nasdaq really fulfilling or continuing its role as a leader this year, which is contrasting to last year. Nasdaq is up over 3% over the last few days. And let's just take a longer term look at the market here. Here's the S&P 500 over the last 9 months. You can see we are right up against this late November, December peak that we had there. Going to have to climb over that, already over the 200-day moving average. So we keep having these incremental technical levels, but 4,100 is really the level for me. NASDAQ also in a similar situation, trying to overcome its highs from late last year. The Russell 2000, though, let me just change this to a candlestick view. You can see just barely breaking out. And on top of that, we got stocks, we got the chip stocks ready to break out here. We also have transportation. So let's take a look at the sectors. We have communication services, that is in the lead, that's up 0.5%. Industrials, also looking at consumer discretionary, that's in the lead, and financials. Those have been some 3 winners this year. Tech taking a little bit of a backseat. I think that's on the back of those Intel earnings. Let's take a look at that board. You can see Intel down 10%, KLA down 7%. A lot of red here, but not deep red for the most part. Software, kind of a mixed board, more red than green. IBM up 0.33% there. And let's take a look at what's happened with our sector for the week. And you can see it's all about the mega caps. Consumer discretionary, the worst sector last year, along with communication services, and then tech, and then financials, and then energy. Interesting mix of not only the value, but also some cyclical sectors there, some growth sectors. So a pretty good mix going forward. Let's check out the leaders. ARC, and this is over the last 5 days, ARC is in the lead. That's up 5%. I talked about defense, ITA, that is a defense ETF, that's up 4%. Even with those Intel earnings in that red screen we saw with the chip stocks, those are up 4%. So all in all, pretty risk-on week here, and we'll have to see if this can continue throughout the day into the close, and of course next week as well.
We will see. Jared Blickery, thanks so much. All right, the latest Federal Reserve decision on interest rates will come February 1st. Here's where investors are thinking rates may head this year. As you can see on the chart, investors see a 25 basis point rate hike next week. At the March meeting, another 25 basis point rate hike may occur. A pause in rate hikes is seen mid-year, followed by a rate cut by November of this year. Coming up, the Hawks are in charge. Our next guest does not believe in a soft landing for the economy, but is it all about the Fed? We'll discuss coming up.
Bracing for impact. The market might be preparing for a soft landing, but continued signs of Fed hawkishness could mean we're more likely to see negative rather than positive results. Are the markets misreading optimism? Joining us now with more, Calvin C. is BNP Paribas, head of America's macro strategy. Calvin, thanks for being here. We all well remember transitory and how persistent transitory was, ironically, in the Fed's thinking. Are we going to see this optimism over a soft landing as misguided in the same way?
That's what we think. transitory inflation, as you correctly say, was the catchphrase of 2022. And we think that soft landing, which is the catchphrase of a still young 2023, is similarly going to be going out the window. The signs that we see clearly show a deceleration of the US economy going into the end of last year. And we think the data will continue to roll over at the beginning of this year, solidifying our call for a recession.
What data is going to be the first to really roll over, perhaps, and then trigger the rest of what the Fed is watching and their core indicators that they're keeping tabs on?
Sure. The US economy, as we know, is a consumer-based economy. So the key really is going to be what the consumer is doing, how much they're spending, and as a result of that, how strong the labor market is. The Fed has been consistently telling us to not only focus on realized inflation, we know it's coming down this year, but to also focus on the employment side of their mandate. Employment is still incredibly strong, and the Fed wants to see signs that it falls apart more rapidly before feeling more comfortable taking its foot off the brakes. So for us, we think the risks are towards a more hawkish Fed next week.
Calvin, I talked to Amex's CEO this morning, and he told me he's not seeing any recessionary signals. Are execs just missing something? It's just amazing to hear a lot of execs just downplay the threat of a recession.
So far, the signs haven't necessarily been there yet. The end of last year was stronger than most people expected. Again, fourth quarter GDP was strong. But when we look forward, remember, monetary policy, as we know, acts with long and variable lags. And these long and variable lags, we think, are finally hitting the economy. And given what we've seen intra-quarter in the fourth quarter, that to us is showing signs of deceleration, a weakening consumer, weakening imports, inventory builds. These are all signs that we see that confirm our belief that a recession is going to happen, and the markets don't have this priced in.
So talk to us about how this is going to manifest with the Fed. You mentioned next week we might get a more hawkish Fed. Does that mean that the consensus around 25 basis points is incorrect, or do you think it's more going to be a tonal shift, if you will, from the Fed?
We think that a 25 basis point rate hike is pretty much locked in, so the markets have that right. It's about what the markets have priced going forward. The markets have a very dovish path priced in for the Fed. The markets don't even have the Fed's median SEP outcome for terminal priced in. And the markets are pricing in a very rapid pace of rate cuts in the back half of this year, which we don't agree with. So we think the Fed is going to continuously push back against those rate cuts. And as those cuts are taken out of the curve, we think that's one of the key catalysts that's going to get risk markets down. So
just to put a fine point on this, there's been this whole debate over that the markets and the Fed are not in the same place. Who is going to be right and who is going to be wrong? You say the Fed is going to have it here.
Based on what we see now, we think it's going to be the Fed. And that's really based on our read of inflation. We think that inflation is going to remain very sticky. It's going to come down, but it's going to remain above target and at elevated levels. And so long as that's the case, and so long as the labor market still remains relatively strong, we think that the Fed will want to keep policy in restrictive territory for a longer period of time.
So for all the investors that have been hearing a recession is coming, what is the strategy then for their portfolio?
So for us, we have trades that we like across asset classes. In equities, we think that given the markets are not pricing in a recession, the markets are very complacent at the moment. What we see is that risk premium is very low. So we like to own equity volatility. We like to buy the VIX. Concurrently, we would like to finance those positions by putting on payers in the United States in the front end of the curve, i.e. betting on the Fed not cutting rates this year.
And also more broadly, I mean, the sort of consensus among strategists on Wall Street is that stocks will go up this year a little bit, won't be a lot, going to be kind of a meh year. Do you think that that scenario is also too optimistic? Are we going to see more of a harsh come down for U.S. equities?
We think it is too optimistic. We think that the markets are just priced in now already for a soft landing. The markets are pricing in roughly 10% earnings growth next year. The markets are trading at about a 17.5 times multiple. That's already pricing a soft landing. As the economic data deteriorate, as the markets move towards our recession view, we think that there's at least another 10% downside in stocks this year.
All right. Well, thanks for the cheery outlook. Maybe realistic outlook. We'll see. Calvin C., thank you so much. Head of America's Macro Strategy at BNP Paribas. Thank you.
Thanks for having me.
Coming up, activist issues. Tensions are high between Elliott Management and Salesforce. Saz has got a take next. Salesforce's board refreshment process continues as it appoints 3 new independent directors following the multi-billion-dollar stake from activist investor Elliott Management. What may be written in the clouds for the future of this multinational tech corporation? Wow. That's where we find today's Saucy Take. I like this euphemism, refreshment of the board.
Yeah.
They're very refreshed.
I wish there would be some resolution, right? This whole ordeal.
It just started.
Well, this whole deal really kept me up late last night, and we could all use our beauty sleep. You know, I mean, you can't be working till like 9, 10 o'clock sometimes, even me. But nonetheless, here's what we got news. Yesterday at night, what I reported was a person familiar with the matter telling me that Elliott is looking for a major board overhaul at Salesforce. Now, I originally thought that Jesse Cohen, widely followed portfolio manager at Elliott, would be the one put forth for that board at Salesforce, but the person or the source for me on this suggests they might put forth several directors, potentials or nominees ahead of the nominating window opening on February 12th. Now, I think in a way to get out in front of this, because it's Salesforce and they always want to lead and be seen as a leader, they came out this morning with 3 potential nominees of their own. Arnold Donald, which I got to know very, very well, a longtime CEO of Carnival, just a really, really top executive. Sachin Mehra, the MasterCard CFO, and Mason Morford over at ValueAct. 3 solid choices, but I don't think this is going to appease the folks over at Elliott. I think they're working on numerous targets to put forth on this board. Might be 3, might be 4. Now, as part of what Salesforce put forward, you're having Sanford Robertson, director since the early 2000s, and Alan Hassenfeld, who is the descendant of the founding family of Hasbro. We were talking about Hasbro as well. Both longtime directors here at Salesforce. They said they will not stand for nomination to Salesforce's board. So the drama is high. I do think Elliott will come out with their proposed slate well before February 12th, maybe potentially this weekend to get out in front of that Monday news cycle, maybe Sunday evening. But nonetheless, here's what we have here. What activists ultimately want from Salesforce, just based on what I'm hearing and the people I'm talking to, potential asset sales. And I don't think this would be a good idea, just given how far tech valuations have fallen. I talked to one person who may want to see, want to see Elliott, that is, Salesforce divest of Slack, but they paid $28 billion for Slack. I can't see them selling in this type of market here. Better financial discipline, and then ultimately guidance. Right now, Salesforce is operating on no guidance for this fiscal year. The street wants to see what the cost cuts and layoffs they just did, how does it impact earnings, and what does this guidance look like for this year, given the economic slowdown that is impacting the likes of Microsoft, Amazon, and other cloud plays. Overall, my take is this. Even though my desire to get some sleep of late is top of mind, I do think change is coming, and I do think the situation is going to get ugly. You have a lot of big egos here, a lot of big money at play as well, and you have a company in Salesforce that has never had to deal with an activist situation. They have only known growth, and growth at all costs, pretty much since their founding. So I think they do find themselves in new waters, and I just think this is going to get very ugly and get ugly very soon.
Do they hit those targets if an activist kind of campaign is successful in getting Elliott a position on the board?
Well, they have an outstanding margin target, longer term, of 25% now by 2024, I believe, and that would be a big step up from what they posted last year. But the thinking is, if they run their business more efficiently, maybe they hit 26%, maybe they hit 27%, and if they sell off a couple assets, can they get to 28 or 29%? I think that's what the likes of Elliott and even Starboard are ultimately betting on.
All right. That is the take on the day. Coming up, we're going to have the latest data on how consumers are feeling about current economic conditions. That's coming up next.
Welcome back to Yahoo Finance on this Friday morning. I'm Brian Sozzi here with Julie Hyman and Brad Smith. Intel's ugly outlook is hanging over stocks like a black cloud. Right now, though, we're seeing major indices shake all of that stuff off, and they are in the green. But Julie, over to you. Breaking news on the econ front.
Yeah, we got the University of Michigan Consumer Confidence Sentiment Index for the final read for January. 64.9 is where we find that headline number, which is a little bit above the prior reading. 64.6 was the last reading we got here. Current conditions, 68.4. Expectations coming in at 62.7. And inflation expectations have come down just a whisper of a touch to 3.9% from the initial read at 4%. So these numbers look like consumers are feeling pretty good here, which is interesting. The short-run economic outlook, according to the statement here, was relatively unchanged from last month, but all other components of the index did increase in January. And this is really interesting. I mean, I do want to mention pending home sales in a second, too. This is all very interesting as we try to get a more complete picture of what's going on with the consumer. On the one hand, we had December personal spending fall. On the other hand, we had all the credit card makers, that is, say that volumes were up, although they missed estimates. So, it's just a confusing time right now when we try and put all this together. And then put pending home sales, throw that into the mix as well. Down 34.3% in December on a year-over-year basis, up 2.5% on a month-over-month basis. Are you confused yet, guys?
Yeah, well, I just wanted to get to this consumer sentiment nugget, Julie,
Yeah.
besides pending home sales. So in this sentiment survey, they're noting 2/3 of consumers, Brad, they expect an economic downturn the next year. So not exactly bullish.
Yeah, well, here's one of the other notes that's within this, and it comes back to something that is going to have an even more outsized impact to how quickly we may enter into a recession, and that is the debt ceiling. The debt ceiling looms ahead and can reverse, at least this is what the survey of consumers from the sentiment report is saying. It could reverse the gains seen over the last several months. Past debt ceiling crises in 2011 and 2013 actually prompted steep declines in consumer confidence.
That's weird.
Yeah.
Is that not weird?
Wait, what?
Why would the debt ceiling debate affect consumer confidence? We know they're going to figure it out in the end. It's just going to take them a while.
Maybe the U.S. defaults on its debt, interest rates go up, and nobody can go out to eat, Julie.
I'm sure that's exactly how consumers are thinking of it.
That's how I'm thinking.
I don't know. That's surprising to me.
This is a much more theatrical type of Congress than we've seen before, though. And for
I guess so.
all
We've
of the
seen
political
some pretty
posturing,
theatrical Congresses.
Yeah, we have. But this one is like the Greatest Showman type status here. So we'll see what they do.
Okay, that sounds like a challenge for somebody to come up with a musical about this current Congress. It's not me.
Well, today's recent consumer sentiment data showing a slightly higher than expected headline. This, together with yesterday's updated GDP numbers, painting a bigger picture of where consumer sentiment is headed. But is it complete? Factors like inventory buildup could distort the picture. For more, let's bring in Jennifer Lee, senior economist and managing director over at BMO. Jennifer, always a pleasure to speak with you, and thanks for joining us this morning. Let's just begin with where we find ourselves right now in the economy. I mean, we were just having a little bit of a discussion on the debt ceiling, which could be another kind of looming cloud overhang here. What's the most notable data point that sticks out to you right now that we should be giving more attention to?
Good morning. Thank you for having me on. I think overall, it always comes back to the U.S. consumer being the biggest and most important part of the U.S. economy. That's what we should always be watching. But at the same time, as all of you were just talking about, this is such an interesting, different time in the economy. And it's so difficult, I think, to make a very firm call, I think. But I think this all the indicators coming together, up, ones that are up and ones that are down, it just goes to show that the U.S. economy is sort of acting as the Fed sort of has been expecting. They've been slowing down. It's been gradually easing into this whole world of very tight monetary policy. And the economy is slowing. And we're probably going to see a mild recession in the first half of this year. We're still sticking with a mild call for now, and we'll see how things fare. But this is all, to be expected. Things are sort of like coming according to plan, I guess, and in many ways after 425 basis points of rate hikes.
Well, Jennifer, up until now, it looks like the consumer has been holding up relatively well. How much is that going to change here as maybe conditions deteriorate further?
Well, we already saw, the December real spending pulled back. November's slight increase, to the fourth decimal, was revised down to a negative reading as well. So that, of course, signals that the U.S. consumer is becoming more cautious. They're sort of fighting back against higher prices. And at the same time, it was interesting that a lot of the gains that we saw for Q4 as a whole was front-loaded. So there was a big gain in October, slower in November, and then an actual decline in December. So it's sort of depends on the space, how you space it out during the quarter. But I think what was even more important or notable was that wages and salaries continue to increase. So even though, yes, it's not great news for the economy or for GDP when consumers hold back, but at the same time, as long as they have that little nest egg, as long as they have money coming in, I think that is the most important factor to take away. And as long as they have some sort of a support system, some sort of a savings cushion under their or behind them, that shows that there is room to grow later. They may not be spending in December, but you could start seeing some more spending coming back in January. I think there's some one of the automakers or one of the research people in the auto sector was saying that there could be a big increase in auto sales potentially for the month of January. So we'll see how we could see some bounce back on that point.
Jen, investors are awaking today and they see news on our platform that Hasbro is laying off 15% of its workforce. I always look at Hasbro as a great pulse on middle America. On the other hand, you had a pretty strong outlook for American Express. Is the consumer spending environment just right now being driven by the high end, and that low end consumer may already be in a recession?
That is a good point, and there's probably some truth to that for sure. I mean, whenever you've got this environment of higher rates, it's going to be the lower end that's going to suffer the most. The ones that are have their incomes are not as high, higher debt levels, especially so they're going to be it's costing more to service that debt. But at the same time, it's interesting. So I think some of the higher end consumers who are looking at one of our analysts who covers the boating industry, for example, seeing a softening on that front as well, but still an interest. So it's not a broad-based decline or setback for all consumers, but it's certainly starting to hit at the lower echelons now, and then probably at some point starting to creep up a little bit. But we'll see how quickly that moves along.
We continue to hear from some businesses about just normalization and getting back to pre-pandemic at the same time where the reality that's being painted going forward from here is vastly different. And so what does normalization look like in an environment where we have heard all of them need to acknowledge in one factor or another the risk of a recession?
So normalization, I guess it's anything, before this whole crazy pandemic began. And it's interesting how, even though we've seen consumer spending pull back over the last couple of months, I think over the longer term, I think we're looking at about a 2.5% growth rate so far for real PC, which is basically in line with what we were seeing before the pandemic. So this is all coming back to normal times. I mean, remember, we pulled back so much spending at the beginning of the pandemic, and then it surged as everything opened up and we rebounded it back. And now we're starting to come back down to more normal levels, and that's probably what we're seeing now. But again, what makes this period so different is because the labor market is still very, very strong. It's not as strong as it once was, but at least we still have, over 10 million of job vacancies out there, which outnumbers the number of unemployed Americans by a factor of almost 2. And that bodes well for, I think, for the U.S. consumer, at least the fundamental picture surrounding the U.S. consumer.
Jennifer Lee, Senior Economist and Managing Director at BMO. Have a great weekend. We'll talk to you soon.
You too. Thanks.
Before we head to break, let's get a look at Amazon ahead of its February 2nd earnings release. Jefferies analyst Brent Thill is keeping a buy on the stock into earnings, knowing that valuation feels too low, says Thill. Valuation is pricing in a macro uncertainty, with shares trading at near lows relative to the Nasdaq, reflecting a belief by investors that estimates are too high. Investor confidence in Amazon's operating income estimates remains the key hurdle for shares to return to outperformance. Coming up, H&M saw rising costs slash profits in the fourth quarter. Julie will break down that, plus have more top headlines next.
Let's get down to business now. Here is what we're watching in terms of other headlines this morning. Rising costs erased almost all of Hennes and Maurits's profit last quarter. The Swedish retailer, known of course as H&M, said surging costs for energy, freight, and clothing raw materials, plus the effect of a still strong dollar, caused an 87% drop in operating profit. H&M is also feeling the loss of its shuttered business in Russia, which was its sixth largest market. H&M results, by the way, in sharp contrast to luxury goods conglomerate LVMH, which saw its sales rise last quarter, albeit at a slowing pace than earlier in 2022. Its Louis Vuitton label surpassed 20 billion euros in sales for the first time last year. LVMH boss Bernard Arnault, who also happens to be the world's richest man, said China sales are rebounding, and if early 2023 trends continue, the company will have, quote, another very good year. Meanwhile, billionaire investor Bill Ackman said he found the short seller Hindenburg Research's report on India's Adani Group, quote, highly credible and extremely well researched. Several of Adani Enterprises companies have lost nearly $10 million in market cap following the report, which accuses the conglomerate of improperly using offshore tax havens. Adani Group has called the report maliciously mischievous and unresearched. And the Food and Drug Administration is no longer looking to regulate the over $5 billion CBD market. The agency says CBD cannot be considered a dietary supplement or food additive, and it will require a new regulatory pathway. The FDA notes that there are too many safety risks relating to long-term use, including possible liver damage. It will work with Congress, it says, on a new path forward. All
right, we're just a few days away from a big earnings report from Apple, which comes against the backdrop of slowing growth and layoffs at fellow tech giants Microsoft and Amazon. Yahoo Finance tech editor Dan Howley is here. Dan, any good news on tap here from Apple? Convincing.
No. Yeah. There's a number of problems that they're actually facing. Chief among them is the iPhone sales, right? That's still their bread and butter. That's still where they make the vast majority of their revenue, more than half of their revenue, actually. What we're talking about now is we kind of discussed this earlier this week, is the drop in smartphone sales that we're expecting. IDC says around a 14.9% drop in iPhone shipments in Q4. That's the holiday quarter. That is not good for Apple. So as far as the estimates for this coming quarter, we just had them on the screen there. They're not looking fantastic. We're expecting to see a year-over-year, potentially year-over-year decline from what Apple had previously posted. Obviously, this comes as there's this kind of pushback from consumers where they're not necessarily buying these kinds of tech products that they were during the pandemic. Outside of the iPhone, we had Luca Maestre. He's the CFO at Apple, basically saying, look, Mac sales are going to disappoint you this quarter. The issue is that too many people went out. It's the same thing that Microsoft's dealing with, same thing that Intel's dealing with, and bought computers during the pandemic. They just don't need them now. Apple launched their new MacBooks with the M2 chips, the M2 Pro and M2 Max. Those only came out recently, so they're not going to help this quarterly report, but it could help in the coming quarters. And then, oh yes, services, that also might be hit. Luca Maestre, again, pointing to FX headwinds, and that's going to be a big problem for them. You can have as much Ted Lasso as you want. It's not going to do very much when you have to deal with headwinds. I'm going to throw this out there. Ted Lasso, that's fine. Severance, get at it.
I've heard that, actually, although I have not yet watched it. There was a report, right, that Apple was getting a little bit of market share in China, right? Is that something? Is that good?
It's something.
Good.
Their market share isn't terrible in China, but that's one of their larger markets, right? They'll never be able to do without China, and everything that happens in China for them is a big deal. And you look at what's available there. Apple is still a luxury product there. We talk about how sure China is saturated in the market. Yes, they gain market share, but it's not going to be these incredible gains that you once had. The new market that people are talking about now is obviously India. The problem is iPhones are way too expensive for the average person there, like out of reach by a country mile. So, it's not going to be easy for them to gain market share there. That's really, the Samsungs, the Xiaomis, kind of the smaller players On the China side, not necessarily Samsung being small, obviously, but I think that this is going to continue to be a problem for them, just as far as the balancing act with market share in these other areas.
We were looking at the IDC report earlier this week as well, just looking at the number of refurbished phones that are also going to be a part of the broader shipment equation over the course of this year and had been last year too. Typically in times of an economic downturn and internationally, a lot of consumers will shift to some of those refurbished phones as kind of a hedge against price. Is that something that we're anticipating once again this time?
I mean, it's interesting because there's a contingent, I think, of consumers who only want new. You talk to my mom, if you buy something that's refurbished, you might as well be buying trash. It's crazy. I think that it's fine. I think that if you can get a refurbished phone, you should. Or just refurbish your old one. Don't tell Apple I said that.
And is that something that Apple gets concerned about?
Well, that is something, right? So remember when they were replacing the batteries in phones?
Right.
When you got a new battery, your phone's going to last a lot longer than it was. So why go out and buy a new iPhone? They build phones that the processors last years and years. Why buy a new one? So that was actually a problem that they ended up having to deal with. I believe they raised prices on the battery replacements, and I think people now are going back to purchasing. But the whole thing for a lot of these companies is we went away from that 2-year cadence where every 2 years people bought a new phone because their contract was up. T-Mobile pushed back against that. We started seeing the rest of the industry doing that, and now it's more difficult for companies to get their phones out there. Now there's, okay, you can buy every year maybe, but you're still going to be paying for it. So, I think for most people, it's that smartphone sales, you think about it 3, 4, 5 years now. It's not necessarily something that you're going to do every 2 years. That's why you start to see, Apple really trying to push the idea of innovating each time they put out a new phone, whether that's on the camera front, the new dynamic island, which, I mean, it's cool, but it doesn't really, I'm not buying a phone for a dynamic island, and the new display technology. So, we'll have to see what they have with the iPhone 15. Hopefully it's something that really gets people going, but, I think we're going to continue to see these issues with sales for some time until at least, the consumer starts to feel better about buying. The explosive growth we saw during the pandemic, that was just unprecedented, though.
Do you guys know how long you've had your phones?
I literally was just about to mention that.
I have an
just
iPhone
looked
11.
mine up.
When's the iPhone 11 from? I don't know.
6 years ago?
It's got to be 2020.
This is the 14. The 14
That's the 14.
Pro, by the way, 'cause I'm
okay.
bougie.
I have the 12 Pro Max. I got this in 2021, I remember,
So I guess
because
that's
my
20.
previous one just did the blank screen of death on me.
Yeah.
So I had to get a new one.
I mean,
See, I feel like the life cycle of these things is still 2 years. Because like my thing,
oh, really?
I've had this about 2 years and it's starting
your
to
case, though.
slow
You have the 12?
down. The 11.
the 11, that's more than 2 years, though.
No, well, it's
Yeah,
needs to be
upgrade.
replaced.
They're giving them away for free now.
I know. I just
Verizon.
haven't gotten around to doing it.
Friend of the show.
Yeah. All right, we're going to do a full screen element on
One time
who
friend of the
has
show.
which iPhone as well.
14 Pro, baby.
14 Pro? All right, cool. Yahoo Finance's own Dan Halley. Dan, thanks for breaking this down. Dan's also going to join Rochelle Akufo to take a deeper dive into the tech landscape, giving you the latest on layoffs and the impact on your finances. Stay tuned for this week's What Just Happened. That's coming up 11 a.m. And also on the topic of Apple, join Saz and I for our After the Call special on Apple.
You just love your
Following-
cartoon. Your cartoon just cracks you up every single time.
I still got to get a purple sweater. I don't know where that purple sweater came from. It's mohair, I believe. But anyway, that's coming up next week, February 2nd. Coming up, turning bearish on Zoom. We'll speak with the analysts saying there's limited risk reward for the video company. Next. A gloomy outlook for Zoom Video. MKM Partners turning bearish, downgrading the video communications company from buy to hold, slashing its price target along the way to $75 from $100, citing limited risk reward at these levels. The analyst behind the call, Catherine Trebnick, joins us now. Great to have you here with us today, and thanks for taking the time. Take us through your thesis here on Zoom.
So basically, my original thesis was that their cohort groups of Zoom Room, Zoom Chat, Zoom Phone, events, whiteboard would actually reaccelerate revenue. And it just hasn't happened. I mean, right now you have really tight budgets. People are looking to consolidate down the number of vendors they have in the IT departments, keep things on track, keep costs low. So basically, with a saturated video market, I had expected the enterprise to really take off with the cohort group, but that just didn't happen. And so I decided to move to the sidelines. To just give you some stats, enterprise was, we're expecting it to be 55% in FY23 and going to 60%, but only growing at 14% year over year. And what's happening is they're not adding enough new logos in the enterprise department. In 2022, they added 50 new enterprise logos. We're forecasting 23 in FY23 and only 10,000 FY24. So between the very tight budgets, we had thought international would be a big factor in growth in 23 and 24. Obviously, we've had really heavy foreign exchange headwinds with that. They've put in a $14 million headwind for their guide. So that isn't happening. Also, countrywide, we've been hearing from our proprietary research that they're excelling in some countries and not others. So they're looking to really figure out how to excel in France and Germany. For example, you can't sell Zoom phones in France if you don't have a staff in France to, sell the phones, right? So it was, even though on a positive point, the Zoom phone is doing extremely well and they've done 4 million seats in less than 3 years, but they sold so many, they don't have enough staff on site right now to really help with the elegant integration and delivery. So just a combination of a few things made us think maybe we need to move to the sidelines.
Catherine, I think it's worth digging into some of these individual things. But first, I have sort of a more existential question about Zoom, which is, does it make sense to have a video calling company as a standalone entity? In other words, we see something like Microsoft Teams, which I think has taken some market share, right? And it can be part of a suite of offerings from the likes of Microsoft. Does just having the video calling piece or even the Zoom phone piece, does it make sense without more stuff around it?
Well, I think it is a very good, well-run company. I mean, the CEO's done a phenomenal job. They're very good at innovation and engineering. And look at the proliferation of products they've added just in the last 3 years. So, I mean, Cisco also is a networking company, a security company, but has unified communications and WebEx, right? I do think it can be a standalone company. The problem is that you had 300% year-over-year growth in the heat of the pandemic. I mean, most church and synagogue rabbis and priests didn't even know about Zoom, right? And now everybody knows about it. But the problem is it really needed to pivot to the enterprise to grow. And right now you hit this possible recession and tight budgets, and you're just not seeing the growth to reaccelerate and move away from the online business.
Catherine, where is Zoom in 5 years? What does that platform look like?
Well, in 5 years, in 5 years, what they think it will look like will be a workstation hub, right? Similar to, I think, Teams and Google. But, they've now offered email and they've offered up calendaring as a part of that, and to say, hey, you can work within this virtual hub and your workstation, you have a nice suite, right? So I think they are making a play to be a communication hub, but I think at the same time, that's a Hail Mary pass right now, and I think it will just lower, maybe, drive down what Teams and Google are paying. It's an idea that has to be fleshed out and see how well they do with it. But that's what I think their vision is to be this hub, but, to be determined. The other thing is, they have $5 billion in cash, correct? And if the revenue is forecasted to just stay at 5% in the next year or two, Now, will he make a really aggressive acquisition, in the next year to really, accelerate that revenue?
Acquiring who?
Well, who could they buy, right? I mean, they tried 5.9s 2 years ago, and the 5.9s investors, didn't like that idea and voted against it. And so then he stuck with his tuck-in acquisitions, made some very interesting acquisitions. That's why they're doing so well out of the box with their contact center. But, to be determined who. I'm not a good predictor on who they might buy. I mean, they could definitely, contact center is a big deal. That's one area of spend right now that is very stable. You have Avaya in a lot of trouble right now with their problems, and a lot of their customers don't want to stick around for a second bankruptcy. So there's opportunity there. So they could look to buy maybe a Genesis or even go back and visit 5.9s in the future. But right now, I would say, with the $5 billion in cash, it's going to have to be around the communication hub. Either they have to buy a unified communication player that does a better job at voice, just besides the phone. Maybe they take a look at Ring Central if that stock price comes in more, and they marry that up with their video, or they go off and buy contact center and really push out on that. Those are a couple of options.
Catherine, I think it was Elon Musk this week on the Tesla earnings call note that Zoom is now available in Tesla cars. Do you view the car as a big opportunity for Zoom?
No. How many Teslas do you sell? Well, how many Teslas do you sell?
Well, not outside Teslas. Do you think Zoom has interest to be a player in the car? Are we taking, I guess what I'm trying to say, are we taking video calls from inside of our cars very soon?
I hope not, Sus.
Well, I don't know. I myself wouldn't want to do that, but they did announce that at their Zoomtopia last November that it was available, and they did show the feature on Tesla. I don't think that's going to, reignite revenue. I really think the revenue comes from enterprise and expansion rates in the enterprise, and that's the pivot. And really being either the second one in at a large, United Healthcare, some Medtronic, such large global player where you have Teams, but then you have maybe a second choice for a video player and unified communications.
All right, we'll leave it there. MKM Partners Managing Director Catherine Trebnick. Good to see you. We'll talk to you soon. Welcome to Yahoo Finance.
Thank you.
All right, coming up, some big numbers this week for Chevron. Inez Ferre has the details next.
Chevron missed earnings estimates in its latest quarter as gains were partially offset by write-offs and impairment charges, as well as a foreign exchange impact of $74 million compared to last year. But the full year picture provides a bright spot for the energy company as it reaches records, fueling its $75 billion buyback plan. Inez Frey's here with more details on all of this. Inez.
That's right, Julie. Well, Chevron highlighted record earnings for 2022, record cash flow in 2022, also increasing investments and growing U.S. production. We'll get to that in just a second because the company also highlighting that. But looking at the earnings, fourth quarter earnings came in at $4.09. That came in about 18 cents light of expectations. But also the company disclosed a $1.1 billion write-down on international assets. So expect that to also be a topic during the earnings call at 11 a.m. Eastern time. But looking at the results for 2022, that record profit of $36.5 billion, cash flow from operations $49.6 billion. That's compared to $29 billion back in 2021, and return on capital employed more than 20%. So some significant results here is what we're seeing from Chevron. All of this on the backdrop of the recent announcement of buying $75 billion in buyback in its buyback program, authorizing that. That's 3 times the previously authorized program. And of course, also the criticism from the White House, because the White House has been criticizing oil companies, saying you guys need to be producing more in order to bring down the price of oil in order to alleviate Americans. So what is Chevron doing as far as production is concerned? Well, it will be increasing output from the Permian Basin by 10% this year. That's lower than the 16% hike output in the Permian Basin last year. But nevertheless, the CFO Pierre Breber in an interview saying, look, we are doing it all. We had record oil and gas production last year. An overall CapEx budget is up 30% in 2023 relative to 2022. And 2/3 of that CapEx is in the U.S. So really, Chevron is basically responding to both the shareholders. We are giving back cash to the shareholders, and at the same time also responding to the criticism from the White House.
Seems like with that buyback, Inez, Chevron has really set the stage for further gains in its stock price.
Yeah, I mean, look, the stock is coming off all-time highs, so how much more is there to gain? But the analysts that we've spoken to are saying that maybe it won't repeat the 53% upside that you saw in 2022, but certainly there is more to gain. Also, do want to point out natural gas. Keep an eye out for this, because in January, Chevron announced a significant discovery of natural gas off the coast of Egypt, and now it already produces natural gas off the coast of Israel. So this will be important, because as Europe looks for more supply of natural gas, Chevron could step in there. So another reason for investors to buy in.
Inez Frey, thanks so much. All right, Chevron's $75 billion buyback plan has shareholder returns in the spotlight for energy companies as earnings roll in. But with Chevron posting disappointing fourth quarter results, what could this mean for other energy names? Here to discuss is Neil Dingman, Truist Securities Managing Director for Energy Research. Neil, good to see you here. What should investors take their cue from on Chevron? These, I don't know, less than amazing earnings results, or do they go all in off that buyback?
Thanks for having me. I think it's both of what you said. I think number one, I think my companies are set up, I call them good this year. They're not going to be great. Shareholder return, I mean, even for Exxon, I mean, or for Chevron, is going to be nearly free cash flow is going to be about $30 billion. That's versus about 37 last year. So look, it's still stellar free cash flow. Is it going to be the record we saw last year? Absolutely not. But as you pointed out, they significantly increased their buyback to now where they're paying back almost 50% of their free cash flow. You know, this is still trails. You look at some of the large independents, like an EOG that pays back 60%, a Diamondback that pays back 75%. So, you know, what Chevron and even Exxon will likely do is, when it comes to shareholder return, putting themselves more in line from a payback standpoint.
After 2022 and the performance that they did see, how are large energy companies really laying out their financial priorities, and how might the stock react off of that as well?
Yes, number one, it's interesting. Prices can go up $10 or $20. Prices can go down these days $10 or $20, and the priorities remain the same. It's number one, protect that balance sheet, and of course, it's stellar for Chevron and Exxon. Number two, continue to have at least stable growth. They have that. And then number three, look at the shareholder return. And that's where these companies now are able to step up, and we're seeing that. So to me, I think why this group still is going to be one of the better sectors out there is when you look, I mean, even, now you look at Chevron, they pay over almost a 4% yield, and they're going to be, as I said, you mentioned, having a buyback that's 3 times higher than what it was last year. So as such, you're going to be receiving back as an investor almost 50% of your free cash flow, which to me is still superior versus any other sector.
Hey, Neil, it's Julie here. Chevron was a surprise, right? Certainly I don't know if anybody on the street was expecting the size of this buyback. Does that mean we're going to get surprises from some of the other majors and also some of the smaller oil companies that you talked about in terms of magnitude? Does this up the ante?
No, you're right, Julie. I mean, it certainly was a surprise to bump it up to 75 million and not even put a timetable on how long they have to do that. I mean, that's and obviously the White House has been even pushing back on that. They'd rather have growth than the payback. For the majors to do that, or the very large independents to push it up to 50, 60% of paying out free cash flow, that's certainly a surprise. What has happened is that, a year or so ago, you've had the likes of Devon, Pioneer, Diamondback, you name it, that have announced that they're going to pay back 75% of their free cash flow. So the precedent has been set with the large independents, and the majors have just been kind of holding out, and now they're starting to play a little bit of catch up when it comes to in terms of shareholder return.
How much of an overhang or a limiting factor is Washington at this point, Neil? Already, obviously, it's been sort of a tense back and forth during the pandemic between producing more, but we want to transition to a petroleum-less future, et cetera. How are you thinking about that as we head into 2023?
I mean, I think still that comes into play, Julie, but I think number one, these companies, like any of my good energy companies, basically respond to what their shareholders ask them to do. And right now, first and foremost, shareholders want a payback. Their comment has been, we've held these energy companies now for some cases 3 years, 5 years, 10 years, and we've gotten very little payback. So it's very now well known out there now that these investors, either through dividends and or buybacks, want some payback. So while, again, they're going to, any of these companies or have to pay attention to the White House, is the White House going to put some sort of tax on buybacks, on any sort of shareholder return? That's wait to be seen. But again, these companies still answer to the shareholders. And I think that's what's clear by the large increase in the buyback announced by Chevron.
Neil, do you think Chevron will execute fully on this buyback?
I do. The timing can be a little bit, again, that's why I don't think they put a timetable. Remember on their last one, which was 25 million, it actually expired. It expires at the end of this quarter. So they had a very definitive term before on what they could do. But again, what they've kind of announced is, look, we're going to pay you back about 50% of our free cash flow. So, again, remember, this is a company that doesn't hedge. You tell me basically what you think prices are going to do. I have a pretty good idea of what they're going to generate in free cash flow, and you have a pretty good idea of what they're going to pay back. So all those sort of blocks sort of start to stack up once you know what commodity prices are going to be or what you think they're going to be for the year.
Neil, good to catch up with you. Neil Dingman, Truist Securities Managing Director of Energy. Thanks again.
Thanks, Julie.
Coming up, layoffs are hitting the toy industry. We'll speak with an analyst from D.A. Davidson on the state of Hasbro. That's next. Hasbro announced layoffs yesterday. The Rhode Island-based company will cut as many as 1,000 jobs. It's a sign of uncertainty, of course, outside of tech. For more on what this means for the toy sector ahead of Hasbro's fourth quarter report, let's get to D.A. Davidson's Managing Director and Senior Research Analyst, Linda Bolton-Weiser. Linda, it is good to see you. So Hasbro, of course, the layoffs are only part of the story. They also gave a pretty dismal forecast for the fourth quarter. And it seems like, bottom line, they're just not selling as many toys. What's going on here?
Well, in fact, the toy demand in the United States is actually pretty strong. Through the first 9 months, point of sale at retail was up in the low single digits against a really strong year last year. So the problem is more with inventory reductions by retailers. So when there were shortages of toys last Christmas in 2021, the retailers really stocked up a lot in the first part of 2022. And then by the time the summer rolled around and consumer demand was a little bit pinched because of inflation, then they had too much inventory. So it's not so much the health of consumers buying toys, it's more the retailer inventory reductions that has caused the low sales performance, the sales declines from the toy companies.
Linda, what role is Mattel playing in just the disappointing results over at Hasbro? Mattel's been doing better, I would say, at least the past 3 quarters, fundamentally compared to Hasbro.
Yeah, Mattel went through a turnaround and restructuring a few years ago and is generally in much better health right now. But Mattel as well will have down sales in the fourth quarter. So they're not immune to the retailer inventory reductions. But in general, Mattel has been healthier. And of course, Hasbro now is not really so much a toy company. 60% of Hasbro's profit comes from their Wizards and digital gaming business.
Is Wizards and digital, frankly, Dungeons and Dragons, is that enough to really kind of be the bridge for Hasbro here?
Well, in the fourth quarter, their Wizards and digital gaming segment was actually up 22% year over year. So they did have a very favorable comparison. They had some launches. So it was the toy division that had the biggest decline, which was down over 25% in the quarter.
Linda, Hasbro's really been dragged on various YouTube toy channels and on social media on how it's been operating that Wizards business. Do you think they have permanently ruined it?
Well, no, we're still optimistic about the long-term growth of the Wizards business, which is Magic the Gathering and Dungeons and Dragons. And, you know, they did exhibit really strong growth of over 20% in the fourth quarter, which I think is evidence of the long-term health of that business.
Is there a continued shift right now in kind of a consumer spending pullback, if you will, of some of those discretionary dollars? Is there more of a shift from toys to tablet? And what I mean by that is kind of this tabletop playing to playing on a tablet and digital gaming instead. And how does that impact a company in Hasbro and perhaps the broader toy segment?
In terms of their Wizards and digital gaming business, in terms of that whole segment, actually about 80% of the revenue is still tabletop. So that really shows you that, you know, Magic the Gathering, for example, is largely still played with actual physical cards. So that's still a very important part of it. And, you know, really little children, you know, little infant babies don't play with tablets and electronic devices as much. And the consumption curve for toys by age has already shifted down to a very low age. That occurred like 10 or 15 years ago. So that's not really a negative impact on the toy industry at this point.
Linda, what does this tell us about anything about how Mattel is going to do or is doing?
Well, both companies, Hasbro and Mattel, had lowered their guidance previously for the fourth quarter. Mattel has announced their reporting date, and they haven't pre-announced a disappointment. So we're hopeful that Mattel can actually do better. They've exhibited a lot more control over being able to forecast their financial results than Hasbro has recently. So we're optimistic they can at least come within the range sort of what the street is expecting, but that is for the declines in the fourth quarter. So it's really affecting Mattel as well. But you can see that the Mattel share price is not even down so much today because I think people recognize the difference a little bit between Hasbro and Mattel.
All right, D.A. Davidson analyst Linda Bolton Weiser joining us this morning. Thanks so much. We'll see if some of the movie and entertainment content is enough to move some more of those toys as well here this year. We appreciate your time this morning.
Thank you.
Coming up, the bad news keeps coming for BBBY, Bed Bath & Beyond. We're going to share the latest of the bad news next. It's time for cover time. 3 stories, 1 minute each. You hear the song, you know what time it is. Let's start with this on the day. BMO Capital warning that the rally for Ralph Lauren may be short-lived after downgrading the stock to underperform, saying that the retailer is nearing pandemic peaks, which may be unsustainable. There's been a lot of closet and wardrobe refresh as people have gotten back out to some of their social functions, but now that we've moved past the holiday season and schedules are starting to dwindle down a little bit, what's that mean for Ralph Lauren and for everybody who's already refreshed their closet?
Yeah, of course, this no comes compliments friend of the show, Simeon Siegel, who is not writing about Peloton for a change, downgrading Polo. I think it makes sense to me. We've seen some bad news from a lot of these wholesale players. VF Corp are out with a warning. It is hard to believe Ralph Lauren is going to post anything good in a couple weeks, no matter how amazing their management team is.
I mean, I don't know. LVMH has been doing pretty good. Some of the other luxury retailers have been doing
well.
But
I can't find LVMH in Marshalls, and I can find them in Marshalls.
Oh, that's a good point. Yeah. You know, it's funny. I was just looking at my Rent the Runway recommendations and stuff, and there's some new stuff from Ralph Lauren, but it's not of how I think of Ralph Lauren. It's much more sort of, it's not classic, shall we say.
So it's unclassic.
It's more trendy-ish,
Trendy.
Which is not what you want from Ralph Lauren, I think. Anyway.
All right, cool. All right, Wedbush is throwing Chewy a bone, upgrading the stock from neutral to outperform, citing steady demand for the company in the resilient pet sector. Chewy had a comeback quarter a couple months ago, so I'm not surprised to see this upgrade. Usually the pet category does pretty well in a recession. Why? Because you're not going to starve your pet.
Yeah, the analyst is looking for faster growth here in 2023. I mean, we've been looking at the various pet product retailers, and there is more discretionary stuff for your pets, just like like food is going to do fine, but maybe you buy fewer toys, not as many of those
look at that little
sweet
sweater
little
for
blankets
puppy.
that are going on the
so
puppies,
cute.
but maybe, I don't know, maybe that
Mouse?
stuff's going to go back.
People are still buying mice out there?
They're pets, Brad. They're animals. They deserve love.
My
They deserve
cousin's daughter
hugs.
has pet rats.
Depending upon what kind of snake you own,
I mean, the cat's
it might
the
be.
cat, a little mice.
Yeah. Within this, though, you talk about consumables. Well, they said that Chewy operates in the resilient pet sector that should continue to benefit from steady demand for consumables in 2023.
Some pet agencies coming after you on Twitter, Brad. I'm not looking, but
And
Don't after
more
me, I don't
trouble
own
in
snakes.
sight for Bed Bath & Beyond. The retailer warning in a regulatory filing yesterday that it does not have sufficient resources to pay off its debt. The stock, by the way, when it came out with this, fell yesterday sharply, but in true fashion, it's coming back today. So, so basically what happened here, it said in a filing yesterday, it got a default notice from JP Morgan Chase, which is one of its creditors. Basically, its inventory was below the amount that the company has already borrowed from its revolving credit facility. All of this, again, all signs point to Chapter 11.
Julie, there's no company left here for Bed Bath. I drove last night. I got myself some Chinese food around like 7:30 or 8, and there was a Bed Bath Beyond right by me. West Babylon, New York. There's nobody in there, and the shelves are completely empty. I mean, this is a company now on the verge of not going bankrupt, yes, but just going out of business. This is a classic story we saw at Sears, Linens and Things so many times. It's
This
really
is happening more quickly, it feels like.
yeah. Well, it's unlikely they're around in a year. I mean, I hate saying it. I mean, we all grew up going here, but this is what happens in retail. The strongest survive, and they're far from the strong.
But it also goes how many layers of management mismanaged Bed Bath & Beyond for so long.
I think the new board member, Julie, you pointed this out, getting a cool $30,000 a month.
We'll see if it helps. Okay,
Helps our wallet.
We are almost done here, but as we leave you, looking at stocks that now are back in the red. We've really been bouncing between gains and losses in this young session thus far. Energy shares under pressure today, but consumer discretionary remains a bright spot. We'll see how it all shakes out. Coming up, stay tuned for our What Just Happened special. Rochelle Akufo and Dan Howley is going to join her today. They're going to do a deep dive into tech layoffs, including a conversation between the man to my left, Mr. Sazi, and Intel CEO Pat Gelsinger. You don't want to miss that.
Alphabet, Microsoft, Amazon, Meta, titans of American industry, multinationals that led the bull run for stocks. The great job creators are now leading a new charge, job cuts by the thousands. Not the regular churn we're used to, more the great adjustment.
Anything that has people implications are probably the hardest decisions we have to make as executives.
Decades-high inflation meant years of easy money dried up. Some will say the Federal Reserve pushed over the first domino, sending the cost of capital higher, leaving tech CFOs with little option but to choose the nuclear option. Others will say big tech got greedy, that it got caught out, that it bet the demand from the dark days of the pandemic would continue, that it didn't have a backup plan. But the reality of losing your employment is real for many. 150,000 jobs in the sector gone in 2022 alone. The tech winter was cold.
When we see a lot of peer companies laying people off, when we see people in the tech industry really struggling, flying in a big performer, spending a ton of money on a lavish party, didn't make a bunch of sense.
It's January and we're already a third of the way to last year's total. Satya Nadella calls it a challenging time. Andy Jassy says Amazon expanded too fast. Mark Zuckerberg took full accountability. Salesforce, Twitter, Lyft, and countless others all have their own reasons. We ask, what's the next shoe to drop? Can the birth of a new dawn in AI create new opportunities? Will the pain simply spread to the rest of the economy? We look to the future for the world's great innovators. Welcome to What Just Happened, Yahoo Finance's deep dive into the story dominating the headlines. I'm Rochelle Akufa alongside Dan Howley, and this week we're inspecting the headcount pullback sweeping across the tech industry as we compute the path that leads us here, decode the foreseeable impacts, and search for what lies ahead. But first, let's roll back and recap what's happened thus far. Dan, give us the lowdown.
That's right, Rochelle. The tech industry is reeling from a seemingly nonstop parade of layoffs across Silicon Valley and beyond. And we're not talking small numbers either. Amazon cut 18,000 jobs, Alphabet laid off 12,000 workers, and Meta let go of 11,000 employees. Microsoft, meanwhile, slashed 10,000 positions, and those are just the major announcements. So it's important to put those layoffs in perspective. Compared to the massive number of employees they hired during the pandemic, big tech companies have cut a relatively small number of jobs. So why are we seeing these layoffs? Well, the macroeconomic situation isn't helping, but each company has problems of their own. Google is dealing with slowing ad sales, ditto Meta, though that company is also pouring billions into its risky metaverse bet. Microsoft has to contend with slowing PC and cloud sales, and Amazon just can't get enough people to buy things from its stores.
I mean, and it's interesting because when you break it down, we hear tech layoffs, but as you're saying, there's a lot of nuances there within some of these companies. And given how much they did overhire during the pandemic, you have to wonder how much more we might see in terms of cuts ahead. And notably, Apple not also on that list as well, Dan.
Yeah, they're seemingly the only one that doesn't have to do any layoffs. There's been talk about how they were very, very easy on hiring during the pandemic. So they didn't go out and say, look, this is all going to change the world entirely. We have to staff up super quick. That's basically what Amazon did. They nearly doubled their workforce, but they went slower. They figured, look, we sell devices. We know that there's demand for devices. We're going to continue to provide those devices, but we don't need the headcount to do that. They already put out more than enough handsets. In fact, for Apple, it was almost a different problem because they were dealing with a chip shortage. So because they are a hardware sales company, they had to contend with that side of the pandemic, not necessarily the staffing up issue. So that seems to be why they were able to kind of move through this time of layoffs relatively unscathed. Yes, there are some hiring slowdowns, but we haven't heard anything about layoffs.
Indeed, we'll be keeping an eye, although they do have hiring freezes, but as you mentioned, they're not layoffs at the moment. All right, Dan, well, the tech industry continues to grab headlines as it undergoes its biggest round of layoffs since the dot-com bubble. But what does this spell out for what's ahead for tech employers and employees this time around? Here to discuss is Ahmed Banafa, San Jose State University professor, along with Betsy Stevenson, University of Michigan professor and former member of the Council of Economic Advisors. A big welcome to you both. So, Ahmed, I want to start with you because I know that during the dot-com bubble, that was something that you were a part of. You were part of those layoffs. So in terms of the worst of it, historically, do you think the worst of it is behind us in terms of the layoffs?
Well, I mean, nobody knows that. I mean, I hope that I have that crystal ball to say that. But what we have seen so far, actually, are big numbers that we see them from the big companies, tech companies just announcing them. And they're saying that, okay, after that, we're going to be fine. Even for a case of Google, the CEO, he said that this is going to help us going forward. Nobody say that we are, we're done with it. That what they're saying, this is going to take us through what we expect in 2023.
And Betsy, I want to ask you, in terms of what we're seeing, obviously the dot-com bubble, a lot of different factors at play here than we saw then. Talk about some of those factors and what that might spell in terms of perhaps what tech employees might see in this sort of environment.
Well, I think there's a lot of things that are different from the dot-com bubble. Well, let's focus on what we've seen in the tech industry so far in the last few years and why they're pulling back a little bit right now. For the tech industry, the pandemic was actually a windfall. Every other industry out there struggled and had a really difficult period in 2020 and 2021. But for tech, this was a period of just massive expansion. All these people who hadn't wanted to shop online all of a sudden were forced to shop online, and Amazon saw a surge of customers. People who hadn't wanted to use social media found it was the only way to stay in touch with people. So they pulled a lot of new subscribers, new customers, new users forward. People who might have been pushed into adopting in 2023 or 2024 or 2025 all of a sudden felt they had to do it at the start of the pandemic. And I think the magical thinking that can exist in the tech sector and was part of what happened to the dot-com crisis, but that magical thinking made them think, no, it's not that we're pulling customers forward, it's that we've created all these new customers and that growth is going to continue as far as the eye can see, and they hired for magical thinking. So what they're having to do right now is readjust for reality. As you've already shown, the layoffs we're seeing here are small compared to not just the hiring they did during 2020 and 2021, but the sort of over-hiring that they did relative to where they had been when the pandemic started. So I think we're seeing a readjustment here, and this readjustment makes sense, and it's going to be helpful to industries that have found it actually hard to hire in this environment, hard to fully recover, and have been looking forward to being able to hire people. So we've just got a little bit of a sectoral readjustment that can be super painful for the people who lost their jobs. But that is part of our healing from the pandemic.
Ahmed, I want to ask about the kind of 800-pound gorilla of the tech industry, Apple. I talked about it earlier about how they were slow as far as their hiring goes. But now we're going into their earnings report next week. We're expecting to see slower iPhone sales. We're expecting to see slower Mac sales. We're expecting some potential problems with services as far as foreign exchange headwinds go. So, at what point does something happen to Apple, if anything? And then what does that do to the broader tech industry? They're a bellwether, right? And if they've been unaffected so far, that's good. But if they start to run into trouble, what does that mean then for the rest of the industry?
Well, that's a very good point. I have a lot of my students, my friends work at Apple. And, during the time when this big rush of hiring people, Apple was really slowing down. I mean, their revenue went up by 52%. Their hiring went up by 19% compared to the other tech companies who really matched their revenue with the rate of hiring. So for looking at Apple, and it's a purely consumer-based company, which means you and I and other, if you don't buy the iPhone, other product is going to impact them directly. They are really related to what we see, what we hear about the inflation, about the possibilities of recession. And they're trying to diverse the sources of their manufacturing by going to India and have something like 25% of their production there, and Vietnam, to avoid any geopolitical problems in the future. But if the consumers start slowing down, and there was a report, from the fourth quarter that the customers are pulling back on their spending, that could impact, Apple. And if Apple starts slowing down and start laying off people, we might go to like a mini version of what happened with the .com or the 2008, because it's actually a leader in this field.
And Betsy, I know we talk a lot about the tech layoffs, but obviously when we look at some of the broader economy, how do the layoffs that we're seeing there compare to what we can expect, if we can expect those sort of repercussions in the broader economy, especially when you have some of these high-skilled workers on H-1B visas having this maximum 60-day grace period to try and get another job as well?
So I'm just going to disagree a little bit here because, when we look at consumer spending, it's been surprisingly robust. We know it needs to slow down. It was too fast, and that was part of what built up the inflationary pressure. But it hasn't actually declined. That's what's keeping us out of a recession. It's continuing to grow. But what happened was consumers gorged themselves on goods. We saw spending on goods that we'd never seen before. And there's only so much stuff people can have. If everybody already has a new iPhone, of course they're going to slow down in buying iPhones. But do you know what they haven't been doing? Getting their hair cut as regularly, going out to dinner as regularly, traveling as regularly. So there's a whole bunch of sectors that would like to see some of the consumer dollars flow back to them. We are absolutely going to see a contraction in the goods producing sector. We're going to see contraction in tech, which is mostly services, but I think we're going to continue to see expansions in other parts of the economy. And so the question is whether those expansions will be big enough to offset the losses in the tech sector. But the tech sector is not the overall economy. In fact, if we look at where most of our job growth and our GDP growth was coming from prior to the pandemic, it's expansion in basic things people need, like health services, education services, and then things people enjoy, like leisure and hospitality services. So all of that stuff is still expanding, and I think will continue to expand enough to make up for some of the losses in the tech sector.
As you point out, our own friend of the show, Sam Rowe, had said how the tech economy basically makes up about 2% of total employment, 2.8%. On that, I just want to ask you really quick about the subscription services that we had seen really blow up during the pandemic. Obviously, Netflix had seen serious share price declines as we rolled through 2022. I guess when people signed up for all of these things, they started to pull back a little bit post-pandemic, or I guess towards the tail end of 2022. Are we going to continue to see that kind of pullback in 2023? Do we see them go back into subscription services, whether that's Netflix, Hulu, Spotify, things along those lines? Or is this kind of going to just flatten out and then we'll just see a return to normal growth that we had seen before?
Well, it's part of the general movement here, and this is a very good point about the subscription services, because subscription services is one of the best revenue sources for any of the companies in the tech industry. Now, for companies like Netflix and the others, it depends on many factors. One of them is what kind of shows they are offering, and at the same time, my vision or my projection is that we're going back to some kind of fragmentation in the subscription services for the streaming services and for the entertainment. This is away from the cable, which has brought everything together. I see that there will be some kind of bringing those services together, and you have seen some kind of a merger between some of those streaming services. Why? Because they want to combine their bases and offer more shows. And this is going to be the same thing for the subscription. The more you look at it, the more it's going to be more selective for the consumers. They would like to get more for their money. And now people are leaving their houses. They go into the theaters. They have other things to do instead of just sitting home like what happened in the pandemic. And the only option they have is to watch, one of those streaming services.
A big thank you to our panel there, Ahmad Banafa, San Jose State University professor, and Betsy Stevenson, University of Michigan professor and former member of the Council of Economic Advisors. Thank you for breaking down the nuances here. All right, coming up on what just happened, Yahoo Finance's Julie Hyman on how we got to these job cuts. Julie.
Talk about why these tech layoffs occurred in the first place, and especially the relationship between the drop in tech stocks and what was happening while the Federal Reserve was raising interest rates. No coincidence they were happening at the same time. I'll walk you through why after this short break. Welcome back to What Just Happened on Yahoo Finance. And to understand the industry-wide job cuts that we're seeing in tech, we have to go back to tech stocks' monster rally before the Federal Reserve started raising interest rates in this cycle. The Nasdaq 100, it surged by nearly 1,500%. If you look back to its prior big bear market low, that was all the way back in 2008, and its most recent high, which happened around November 2021. And that period, not coincidentally, was characterized by what you see on the bottom here, which is ultra low interest rates. We did have a brief period of increases in 2017 and 2018 before rates were cut again. But large cap tech pretty much kept climbing over that period of time. And that's because growth stocks, especially tech, flourish when rates are low. There are two main reasons: a low cost of capital and high incentives for equity investors. So let's talk about that first point. Growth companies want to grow. The early stage model in particular typically involves spending a lot on things like hiring or software development or building a factory that is investing for future growth. When interest rates are low, it's less expensive for companies to borrow money to fuel those initiatives. More mature companies also tend to borrow in this environment. And here's the reasoning. Even if I have a lot of cash on hand, why should I spend my rainy day fund when I can get a cheap loan instead? Investors, meanwhile, were pouring jet fuel on tech's growth. If rates are low and I'm a retail investor, I'm not getting much return on, say, my savings account or really any fixed income investment like bonds. And maybe I'm doing the same as big companies are doing and borrowing money to invest. For example, if I get a loan and pay 3% interest on that, since I'm pretty confident I can make a higher return elsewhere or a much higher return elsewhere in the stock market, for example. All of this reasoning and all of this came to a halt last year as inflation proved to be quite intransitory. The Federal Reserve started raising rates and then it kept going. And that has triggered what's called tightening in financial conditions. Among other things, borrowing costs for companies have gone higher and institutional and individual money is no longer flooding into the stock market. That's all resulted in the womp womp for tech stocks in the past year. Despite a rally so far in 2023, the Nasdaq 100 is still down about 28% from that high that we were at back in November 2021. And of course, some individual tech giants were hit even harder last year. If you look at the likes of Meta, Microsoft, Alphabet, and Amazon, Meta in particular, I think was down something like 68% last year. And there's the idea that investors are paying a premium for growth stocks' future earnings. Their reputation rests on the promise of future earnings. This has caused investors to question just how much those future cash flows at tech companies really are going to be worth in, say, 5 years, and whether the earnings are worth waiting for. As we know, where there are doubts, there is investor pullback. Tech companies cut off from the supply of easy money, wound up cutting costs somewhere, and that somewhere has ended up in part being what we have seen in payroll, Rochelle.
So then, Julie, with that in mind, then, if investors are pulling out of tech, where is the money now headed instead? Well,
some of the money has gone back into tech, as we've seen so far in 2023. But traditionally, when people are looking for a potential slowdown or a recession on the horizon, they go to a few places, right? They go into fixed income, and we have been hearing that from investor after investor. Fixed income, one of the most popular trades this year. That's in part because yields are going up, right? If I'm buying government debt, then I'm getting more for my money. If I'm buying investment grade bonds, I'm getting more yield on my money than I was. So-called value stocks, right? Those that have been beaten up but are still seeing as a value. Financials usually fall into that category. Sometimes consumer staples like Procter & Gamble fall into that category. And then there's some overlap between value stocks and defensives, right? Companies that are seen as being able to expand their profits even in an economic downturn. You've got energy stocks, although there's some crossover with value, as I said, like the likes of ExxonMobil, and then actual defense companies sometimes as well, like a Lockheed Martin.
Well, then, Julie, when can we expect to see a bounce back or a recovery? I know we're starting to see a little something with Meta at this point.
Yeah, with a lot of these tech stocks, we've seen a little bit of a pullback, but a lot of the investors that we've spoken to say tech stocks can't really recover in a meaningful, sustained way until interest rates stop going up or even start to go down from the Federal Reserve. Now, that said, we've had this divergence, right, between the Federal Reserve and where rates have been going. The Federal Reserve isn't done raising rates. It's expected to raise them by another 25 basis points next week. But the 10-year Treasury yield, which tracks rates and perceptions about them, has actually gone down so far this year. That's one of the things that probably has helped the Nasdaq 100, but we don't know if that is going to remain intact, Rochelle.
Indeed, don't know when the Fed is going to take their foot off the gas or pause at this point either. Great stuff there, Julie Hyman. All right, well, coming up on what just happened, our Brian Sozzi will be joined by an important voice in tech. Brian?
Yes, Rochelle, I'll be speaking with Intel CEO Pat Gelsinger after the break. Lots to talk about, and you do not want to miss that chat. Again, Intel, one of the hottest tickers on the Yahoo Finance platform this morning. We'll be right back. Intel's turnaround is going to take longer. The chip maker saw steep declines in its client computing and data center segments in the fourth quarter and is warning the challenges may persist. The company set its Q1 revenue expectations between $10.5 and $11.5 billion, well below the expected $14 billion. Intel CEO Pat Gelsinger joins us now. Pat, always nice to get some time with you here. For those unfamiliar with your story and your background at Intel, how personal is it for you that we're back here and we're still talking about numbers and guidance like this?
Well, it's very disappointing, of course, Sazi, and, always a pleasure to come on the show with you. But, numbers that basically we haven't seen for the company for a decade, projecting losses that we haven't seen for 30 years. It's very difficult. At the same time, hey, I'm committed to see this turnaround through. And we knew it was going to be a hard journey. We knew that we had to navigate through rebuilding execution, getting our products back, having the technology back, making the long-term investments to do so. And hey, I sure would have liked to do so not through such a harsh economic cycle affecting our industry this way. But these are the cards that we're dealt with. We have a tough environment. We're going to keep making those long-term strategic investments, but with a lot more austerity in the core business in the near term. And that's what we laid out for Q1. A very tough picture, but one that I'm confident that we'll navigate through and will make the company better as a result.
Pat, make the pitch that a turnaround can happen in Intel.
Well, we're seeing all of the green shoots, if we could call it. We have the core products shipping now, all of the data center products with Sapphire good momentum on Emerald Rapids later this year, Granite Rapids and Sierra Forest next year. All of those are looking good. We've seen multiple quarters, and last year we gained 3 to 4 points of share in the client space. Good execution on the client products. And maybe most importantly, the 5 nodes in 4 years, getting the process technology back to leadership. And Intel 7 done, Intel 4 it will be ramping with Meteor Lake, Intel 3 on track, 20A and 18A. We're presenting that now, to the market with, so they can start designing as a foundry customer on those process technologies. And, we had another external validation this quarter with a leading edge Intel 3, foundry customer commitment. So all of the things that we said that we needed to do to rebuild long-term leadership, we're on track to do that. And additionally, we laid out this internal foundry model to really attack the operation, the efficiency and cost basis of the company. And that's now well underway. So tough economic cycle, but the strategy for a turnaround, nothing has changed in the formula that we have laid out, and we're on track to accomplish exactly that.
Before we unpack just what's happening in each line of business, and I got this question this morning from an analyst, and Pat, I didn't have the answer. Do you feel as though the guidance that you gave last night is that kitchen sink, that we're not having this chat again a couple months from now?
Well, one of the things in the guidance that we gave is clearly that our customers are making significant inventory adjustments. And if you think about the way, in particular, the PC market works, Sazi, Q3 and Q4 are generally buoyed by holiday refresh and back to school purchase cycles. So customers coming off of literally 5 or 6 years of shortages, right, carried more inventory into the second half of the year. They burned inventory in Q3, they burned inventory in Q4, but still had high inventories levels as they finished the year. Q1, those numbers have come down dramatically. In fact, it's the largest inventory burn in recorded history for us. We can't see any period where they're making such dramatic adjustments. We're, of course, working with customers to make those adjustments, but the amount that we're selling in is dramatically below what they're selling out as they burn through inventory. So we do believe that they're making the necessary adjustments to have much leaner, positions in our customers' inventories and in the channel. So we do believe that, hey, first half, it's going to be pretty rugged as we go through this period of time. But everybody is predicting some level of recovery as they need to buy to their sell-through rates and some level of market recovery in the second half of the year. So that's reflected in the Q1 guide very firmly. We're also saying, well, we're not quite sure. It's still murky picture for the year in that regard. And we're being somewhat cautious as we lay out what the future looks like, but one that we're also very confident in the long-term position that we're rebuilding, for this great company.
And what ultimately ends this PC correction, Pat? Is it prices coming down or employees or people going back to offices and we need to all upgrade these computers?
Well, there's a lot of things going on in the market. One of those is exactly what you say. People going back to offices, they upgrade. We've seen lifetimes continue to increase. But fundamentally, post-COVID, the PC is a more critical device. And with that, this inventory correction, we're still in the, 270 to 275 million unit range is our expectations, for this coming year. We set a range of 270 to 295, we believe at the lower end, but the sell-in rate is dramatically below that today. And that's why you say at some point, they just got to start replenishing to the sell-through rate. The other big factor, of course, is China. Right. And, obviously, we all know the things that they've been going through. So we expect some unique recovery in the China market as that economy starts coming back, we believe. And we heard very positive statements to that effect at the World Economic Forum this year. So overall, we do believe that first half rugged, some level of recovery as we go through the year.
I know you're still dealing with execution issues, still trying to get the rhythm back inside the company. But what is the economic component that you just mentioned, Pat? Do you feel from your perch at Intel that the U.S. is in a recession?
Well, any CEO should never talk about the R word. That's for economists. We believe that, hey, there isn't really good news on the horizon here. U.S., we're still fighting inflation. Europe, still fighting energy in Ukraine. And China, and Asia, still working through the COVID implications. So I say over the 3 big markets, we don't see good news yet. That said, I think everybody left, for instance, the World Economic Forum a little bit more optimistic, Sazi, that we're fighting through these in a positive way, and that the, correction may be softer in the economy than some had feared against that. For us, we're saying we have to go manage the business in a murky environment. We're adjusting costs. We're on track or ahead with regard to the $3 billion cost savings that we laid out. So we're executing, that well. We're adjusting our customer and inventory levels as we see in the Q1 guide. But fundamentally, it's about getting back to product technology leadership that satisfies our customers and wins us back market share.
Is the dividend at its current payout ratio, is that safe?
Overall, we have to look carefully at our capital allocation, and we have a lot going on in the capital allocation budget. As we think about the capital offsets, U.S. chips and EU chips, and what we're doing, for our SCIP program, semiconductor co-investment, the very innovative co-investment program that we laid out. Of course, we're committed to the dividend and to a very healthy and competitive dividend. And we're also making, big long-term strategic investments. So we're putting all of that together and looking very carefully at the capital allocation priorities, for the company overall, even as we remain committed to rewarding our shareholders with the dividend.
You mentioned, lastly, on the earnings call last night that you were looking at other value-creating initiatives inside of Intel. Do you see other assets to be sold? What do you mean by that?
Well, obviously, we're not quite ready to answer that question directly, Sazi. But, I'd point to what we did with Mobileye. Hey, this was one of the few successful IPOs that were done last year. Clearly value creating in the marketplace and showing that we're being creative in how we can move forward with the assets that we have. The SCIP program that we described, semiconductor co-investment, first time that you've ever created that capital co-investment program for asset classes and semiconductors. So overall, we're finding very creative ways to lead in how we manage the balance sheet, and how we're able to, take the assets that we have and present more value to the marketplace. And the comment was really saying, hey, we're working on some more of those ideas. Stay tuned. We're coming back to you in the future.
All right. Well, Pat, you're a good guy for coming on here. I know it's probably been a long few hours, but we appreciate you answering these questions. Intel CEO Pat Gelsinger, we'll talk to you soon. Have a good weekend.
Thank you, Sazi.
Appreciate it. All right, Dan, back to you.
All right, well, despite the thousands of layoffs rattling the tech industry, there are a few companies who have avoided the carnage. Yahoo Finance's own Inez Frey joins us now with the details.
Yeah, Dan, and they are hard to find, but I will say that if you take a look at ServiceNow, this is a cloud software company that recently reported its quarterly results and in fact went out of its way to say we are not cutting jobs in 2023. We are not laying people off. Well, ServiceNow CFO Gina Mastantuono spoke with Brian Sazi and Julie Hyman in Davos last week, and she said that certainly they have slowed down hiring a bit, but they're still continuing to grow. And in fact, when other tech companies have laid off people, well, this has been an opportunity for companies like ServiceNow. Take a listen.
The market right now is interesting for sure, and the ability to snap up some great talent is better today than certainly the last year. So we're taking advantage of that for sure.
And she also talked about the digital transformation, and this is at the forefront of companies, and also saying that they are now hiring. The priority is on sales and engineering talent. Dan?
So Inez, a question here. I mean, besides ServiceNow, Apple has also been able to avoid cuts. We tapped on that a little bit, but why is that?
Yeah, and part of this has to do with the rate at which it hired during the pandemic compared to other big tech companies. So Apple has been very disciplined at this. And if you take a look at the data from September 2019 to September 2022, Apple's headcount grew by 20%. And by comparison, you've got Microsoft, their headcount grew by more than 50%. Alphabet's the same. And in the last two recessions, Apple hasn't had to have mass layoffs. So it's a company that is disciplined with its headcount, with the rate at which it's growing. And so therefore, it's able to avoid laying people off, at least on a mass scale for now, even if there are reports that they may be slowing down their hiring. The last time that Apple had a mass layoff was in 1997 when it laid off about 4,100 workers.
Wow, 1997, great stuff. Inez, thank you so much. All right, well, coming up on what just happened, what's the next shoe to drop after tech job cuts? Jared Blickery has the details. Jared.
That's right. The big story has been the tech layoffs, but we are seeing signs that the pain is spreading to the wider economy. We're going to break it down all up next. Welcome back to What Just Happened Now on Yahoo Finance. I'm Jared Blickery, and guess what? We're watching job losses mount in the tech sector, but what if tech is now? Who's next? And already we're seeing hints of what's to come with blue chip companies like Dow and 3M announcing layoffs, and even toy makers like Hasbro cutting back on staff. So I prepared some graphics today, and I did a deep dive using the BLS. That's the Bureau of Labor Statistics' own data, and that's the data that we report on a monthly basis, coming to you next Friday for those January numbers. Stay tuned for that. But I've started with some of the places where we see the job losses first. Now, these are not, well, startups and high growth is actually not a BLS category. It encompasses a number of other ones, but I put that in there because we've all seen those big tech headlines, some of those companies that were raising so many employees or increasing their headcount last year, finally shedding that today. But in general, we're seeing that in manufacturing. Now, in manufacturing, that can cover many of the sectors that we're typically looking looking at when we talk about stocks. So that could be a PC manufacturer, it could be Hasbro, it could be toys, could be anything. Construction as well, that has to do with the housing sector, and then the wholesale trade. That's before these products reach the retail market. So all of these tend to be indicators early on, and those will often predate what we call the recession. Now, some housekeeping notes here. Recession, as broadly defined by NBER, that's the National Bureau of Economic Research, they're the ones who officially declare a recession, but it's always with hindsight. So we don't know in real time if we're actually in one. And when we say recession, that's including the entire American economy, which is a huge, huge place. So within some of these sectors, we can get a more nuanced view of what's going on. So this is where we're seeing those early stage losses. Now, in the mid stage, we're going to see that finally trickle down into retail, into financial services, into professional services. So we kind of went from some of the blue collar as well as some of the white collar jobs, because that would be chip manufacturing as well, into the white collar jobs, although white collar and blue collar could be involved in retail trade. So you can see there's a real mix of different types and categories that we're talking about here. Now, at this stage, pretty much we already know we're in a recession, and typically, I was talking about the recession overall for the economy, we would first slip into what's called an industrial recession and an earnings recession. So 2 quarters of negative earnings back to back, and this might be the first quarter of those, would be an earnings recession. That usually predates the general recession. And also that industrial recession that I was talking about generally occurs somewhat in line with that earnings recession. Now, in the late stage, I actually have all these categories here, and in fact, I could further subdivide those into 2 categories. So in the what I would call the safe industries, and those are the industries that tend to get hit the least or even counter-cyclical, that would be education and health, government, and utilities. Now, in these industries, sometimes we see an effect late in the game that could be after the recession has already ended, and sometimes with government spending, we see that increase. The amount of employees will increase into a recession, and that's politicians and Congress trying to make sure that the economy doesn't head into recession or recovers from it more quickly. So that would be a fiscal response there. But in the late stage, private sector, leisure and hospitality, information, mining and lodging, those all tend to get hit last. Now, I should also make the point that we all have different conceptions of recessions based on what we've experienced in our own lifetimes. And in fact, every recession is different. All of us remember the pandemic recession, and in fact, that hit leisure and hospitality the hardest, and that's when everybody took their lumps all at once, basically going back to March 20th, and the economy covered very, very quickly. For the most part, I don't even include that in a lot of my analysis because it was so abrupt and so uncharacteristic. Now, I want to show you the last 2 recessions before that. This goes back all the way to 1999, so this shows the dot-com bubble bursting, as well as the global financial crisis that was more oriented toward the financial sector and also the housing sector. So just going along here, manufacturing and construction, those tend to get hit the most. Manufacturing is this line right here, and you can see before the recession started, in fact, in 1999, 2000, barely climbed back to positive. Manufacturing had been in secular decline for a couple decades. Construction, another one that I was mentioning, oftentimes gets pretty hard hit. And then for all the hubbub about the financial services over the global financial crisis, it did not experience as great a dip as some of these other sectors, although for financial services, it was uncharacteristically deep. And then this orange line here is hospitality, and you can see it's actually faring pretty well through both of these recessions, not getting hard hit as some of the others. And as I said, we all know that leisure and hospitality happen to get hit the most. So everything's going to be different, but it gets back to the question, where are we at this stage in the game? All the industries have inflected downwards. All these categories that I've been talking about inflected downwards. They've already peaked in terms of employment as of last year. 2 of those have not, but those have to do with the government industry, so a little bit footnote right there. Are we going to plunge into recession? That's a big question here. We're seeing job losses accelerate to the downside, but we haven't even seen them crack the 1% level. So none of these industries that I've been talking about here has even gone negative just yet. So a little bit of time there. Is that going to happen? That's a big question, and that's what we're going to be talking about in the future. And also, none of this has to do with stock timing. So that's going to be up next, perhaps for next Friday, guys.
Well, thank you for at least breaking down the signals that people should be looking for if we do start seeing layoffs in those sectors. Great stuff. Jared Blickery there for us. All right, coming up on What Just Happened, what's next for tech workers after these brutal cuts? We speak with a woman who's ready to help them get back on their feet and fully funded. We explain how next.
I didn't see it then, but it turned out that getting fired from Apple was the best thing that could have ever happened to me. The heaviness of being successful was replaced by the lightness of being a beginner again, less sure about everything. It freed me to enter one of the most creative periods of my life.
Steve Jobs there on how he felt after he was fired from Apple there. And obviously we see what he went on to do. So of course, while layoff announcements continue to ripple through the tech industry, a positive trend is also gaining momentum. Laid off workers from the likes of Google, Microsoft and Amazon have been sharing their frustration and their resumes online. Now, while focusing on their next job, their tech experience also opens the door beyond big tech firms. Where could they all go? Our next guest believes that many of these laid-off tech workers will go to start their own successful companies. That's why her venture capital firm Day One launched the Funded Not Fired program, which aims to invest $100,000 into 20 new startups that each have a founder who has been recently laid off. Joining us now is the lady herself, Marsha Boucher, founder of Day One Ventures. Good to have you on the show, Marsha. Obviously, a very stressful time for a lot of people who have been laid off here. What are some of the opportunities that you think they can take from their jobs now as they shift into entrepreneurship?
Thank you so much. I think it's definitely a difficult time, and I was in a situation myself a few years ago when I was laid off, and in the past, after being laid off actually twice, I started my first and second company. Day One is third venture that I started. And looking back, I just realized it was one of the most creative periods of my life. And I also realized I would have definitely backed myself then if I had a chance. And right now we have $250 billion of cash that VCs raised and sit on, maybe already more. And we have 250,000 workers that's right now free and on the market and that's got laid off from tech. And I was just thinking it's amazing opportunity, and at least 0.1 or 0.1% of this tech talent would make it into good founders because they land a job in a very competitive industries, very competitive markets, gained a lot of experience, and definitely have ideas to start company. That's what inspired our program. And I think as you laid off, one pathway you could take is starting your new business. because it might not be an opportunity like that later in your life.
Well, Masha, where do you think these kinds of laid off employees who may want to start their own companies will tend to go? Will they go to similar opportunities where they're trying to build their own app? Will they go and try to build the next great subscription service? Is there any idea of where they may end up kind of flowing?
It's a great question. And I think as you think about new company, you should think about problems that would still be around and would be difficult to solve in 10, 20 years from now. And I think climate is one of the sectors. We live in the middle of a major climate catastrophe in Earth's history and human history that we know about. And I think solving this problem as urgently as possible is really important. I think there are other industries, for example, AI is really quickly moving industry. I think we only see the top of an iceberg, and I think it's going to be lots of demand on different sort of generative AI, vertical AI, and lots of applicants can tap into it. And I think there are other exciting industries. I'm personally excited about biotech and opportunities that can rise there on intersection of new technologies like AI and existing science. Or, for example, there is a future of reproduction, and I think this area is going to change in the next few years. So as you think about what to start, I would really ask people to think about what could be the next big thing and not settle down with mid-size and small opportunities.
So all of those sound like they're for the good of humanity, climate change, biotech, AI, as long as it's done well. What about the metaverse? I mean, that was something that everybody kept talking about for months and months and months, and now it doesn't seem like that's being spoken about very often. I mean, do we see people trying to move into there because they still think it's hot, or do they go into the climate sciences, the AI, the biotech?
Well, I think metaverse is definitely exciting, and there are lots of really solid teams that keeps building in metaverse. I think metaverse in a way been existing. I think intersection of gaming and metaverse is the most organic and natural use right now. The way I think about metaverse, I don't think we have to rush anywhere. We build this world that surround us for so many centuries, and we expect to build metaverse that we want to live in within a few months. It would be naive to think about it. I don't expect it to take centuries, but I do think it's going to go through so many iterations before there is a point that people willing to spend time there. And I think there is a huge amount of creative talent, not only technologists, but artists excited about this opportunity. And I think it's definitely one of you. But there is another thing, AI and layoffs, right? And I think lots of big companies might be laying off people because I understand how AI will replace unproductive workers. And on the one hand, it sounds really bad. And on the other hand, I think it's a force that we're not going to be able to stop. And I think there is only two ways how we can deal with it. I think one way is definitely supporting new companies and entrepreneurship. And on the other hand, I think we have to support education and re-education because I think the next area where you can do next big thing is education and modern education. And I don't think there is enough companies that can absorb all this talent and give new career opportunities for people which jobs stopped existing.
Certainly, obviously, a much wider gate here now for jobs of the future when you bring in things like Web3 and the metaverse. We'll have to leave it there, unfortunately. Masha Boucher, thank you so much, founder of Day One Ventures. All right, well, as we continue with what just happened, lots of food for thought. So, Dan, where is your focus for tech in the coming weeks?
Yeah, I think a lot of what we have to look at is, not just how the services side of things is doing. Obviously, we've discussed Microsoft because of their earnings. We're looking forward to Alphabet and Meta to see how the ad market's going. But I think the bigger question really is, Apple's earnings coming up because they're a pure play consumer company. I mean, yes, they have a business side of things where companies like ours will purchase MacBooks, but the vast majority of what they do is sell to consumers. And I think that's going to give us a better sign of where the consumer actually feels they are right now as far as comfort level, right? The idea of the PC market slowing down, okay, people hold on to their PCs for 5-7 years or until it starts spitting dust out the back of it. But I think the iPhone, the sales of things like iPad that signs up for services. I think that's going to give us a better indication than the PC market itself.
And I mean, we also have Google Alphabet's earnings that are going to be coming out as well, February 2nd. And I mean, we have to keep in mind that even though people are they're laying off at the moment, doesn't mean that this speaks necessarily to the health of some of these companies, but perhaps see them more strategically, really allocating this capital to other parts of their business. And I know you tapped on a lot of the nuances within the companies. All of them are having that same macroeconomic backdrop, but then within them, when you think of things like China and manufacturing supply chains for Apple versus, say, a slowdown in cloud for companies like Amazon and for Google as well. So it does mean that there are still opportunities. We know that even when it comes to things like cybersecurity, more than 750,000 job openings. So we shouldn't really just couch it in the fact that these are layoffs. People are moving to different parts of the businesses. And, there's obviously still a future. A lot of big tech companies here still hiring, just a lot more strategically as they were during the pandemic, Dan.
Yeah, I think, personally, I have a bunch of friends who got into coding during the pandemic. They're still able to find jobs, no problem. So I think that's going to be, the sector's hurting, but does that mean that there's no jobs out there? No, there's other industries that need these people, not just the tech industry. There are tech jobs outside of the tech industry for sure.
It's true. Big tech gets all the headlines, but obviously jobs of the future attached to these other industries that still need tech as well. We'll have to leave it there. That does it for now. I'm Rochelle Cooper along with Dan Howley. We'll see you Monday morning at 11 a.m. Eastern. Have a good one.